Oh. Okay, looks like we're back. Just steals his wall. Lights are out. Is it on a different stream though? Jeez, it's on a different stream. Frick, it restarted everything. I think that was Restream's fault. That's not cool, man. Good morning. Good morning. I need new likes. Such a pain. If Twitch doesn't start blowing up, I'm not gonna do Restream anymore. Spy's coming down there. Too many green candles broke the internet. Pretty much. The lurkers got left behind. It's a good way to flush out the lurkers. Lurker flush. Yeah, can I even go back into that chat? I want to put a link for this one. I think that chat's still around. Might not be. Dude. You guys are still have that chat open? Can you put a link to this stream in there?
Peterson. He's Director of Derivatives at the Schwab Center for Financial Research. Welcome back to the show, Nathan. It's been a few weeks.
Yeah, I was basically out the whole month of March there. Did I miss anything?
Yeah, you missed quite a bit here, Nathan. I kind of want to dig into, a continuation of this jobs conversation that Kevin and I had. Jobless claims came in higher than expected, back above 200,000, and the big revision. And we've seen some weakening there in other numbers, such as JOLTS, ADP. We've got non-farm payrolls tomorrow. What's your takeaway here is the Fed's job doing the work that it needs to do to kind of crack this jobs market?
Yeah, that's what it would appear like. I mean, we're getting a sense of how much of a lag basically there's been. I mean, we know they started last March in 22, and perhaps that is what the window is in terms of seeing some of this slowness begin to come in. And, perhaps also some of the regional bank stuff had something to do with that. But, Tom, you had mentioned that bad news is good news, and I'm kind of questioning that because what I saw this week when I came in, you look at JOLTS, and they came in much lower than expected, and that's like a looser job market. You would think that would be good in terms of helping out the Fed in terms of accomplishing their jobs and becoming more dovish and not doing as, being as aggressive, etc. Bond yields, the bond market responded appropriately. They broke below that 3.4% key support level. We're now at 3.28 on the 10-year. And then you turn to the equity markets and you think, hey, we got a 1-2 punch here. Yields down, looser job market. We should be going up, and we didn't. And then it was followed up by ADP. That number, I understand. ADP is all over the place.
Yeah,
and
MCOM.
It doesn't necessarily translate to
MCOM could have still
so
big
I'm not
move.
so convinced about the ADP. But then
I'm
we
watching
did
this one
see the initial
pretty
claims
close.
like you guys were talking about. And
Its
that
chart looks
is
very similar
kinda
to BY at
speaking
this point.
to,
It's just a month ahead because they already split.
Does the market want to see weak economic data? I think they do want to see some gradual softness. So lukewarm data or slightly cool data, but they don't want. I think there's some concern.
I don't know. I
that,
think Restream something messed up.
If
So
we
the stream had to
continue
restart.
to see some degradation in the economic data, then does that translate into EPS?
I think a
Are
vote
we still
yes.
seeing more
They literally put it in their
effects
filing.
from
If you
the
vote
Fed,
no,
et
they're
cetera?
gonna go bankrupt.
And then let's also not forget on the
So,
regional banks.
maybe that's
and
fine.
what's
Maybe
going
that'll cause
on
a
there. I don't
squeeze
think
if
anybody
they announce
knows
bankruptcy.
whether that's over, but we've got First Republic reporting next Thursday. They're kicking off financials, basically. That should be an interesting report there. Then we get the big banks next Friday. We get CPI next Wednesday, PPI on Thursday. The VIX is only at 18.9, so the market doesn't seem too concerned about anything right now. I think it's probably underappreciating the potential for some volatility next week. And those financials, when we get the numbers in terms of deposit flows, I think it's kind of a binary event. Are there any more skeletons out there? Has it stopped? Or has it been priced in and you get
Reverse
some kind
split
of
does not mean bankruptcy, no.
Yeah, Nathan mentioned the volatility index, Kevin, starting to fall.
Right.
And historically, towards the end of the week, we have seen it fall, whether the market's up or down, maybe just some repositioning ahead of the following week. But we've got a bunch of big data points next week.
I'm going to give a counter theory that I want you and Nathan and I to discuss, and that is this.
Hey, Mark.
The all-time average for the VIX is still 15.4.
How'd your average go from 20
since
cents
they went to the
bucks?
S&P 500, right? And you're right. It's spent 24, approaching
job.
36 months, way higher,
Nice, well done, man.
historically
What
high.
field?
So it does feel cheap.
How come BlackRock haven't sold it?
However, we
don't know.
have to
I don't know why any
understand
insiders
where we
haven't
are
sold.
in the calendar, moving into spring and summer.
Maybe because
we have to
borrow
understand
fee?
that
I
a
don't know.
lot of the reasons have now dissipated.
It's such a small
And
position
the
for them,
question is,
too, that maybe it doesn't really matter
VIX
anyways.
really low going into a spring and summer around 18, 19?
Yeah, I mean, I think with all the uncertainty in the market, that's the concern that I think a lot of traders and investors are having, is the fact that, yeah, it's lower than it has been over the last several years. It's at the low end of the range, but at the same time,
But we've seen lower, Tom.
Oh gosh, we saw it below 10.
Yes, I've been
before the
there.
pandemic,
I've been
yeah.
standing there going, it's never going up again ever, is it?
Don't buy any options.
Yes.
That's what I used to
Don't
say
buy
to myself
summer.
on the trading floor. But Nathan, there was some commentary out of Fed Governor Bullard. He's the most hawkish, it seems like, on the Fed board. At this point, he says, hey, we can't sit back and let inflation kind of stagnate at these areas where that's one of the biggest dangers in the market right now. But he did say, that some of the data has been declining, but they have to keep on their path of rate hiking. But, CME FedWatch's tool is basically saying they're not going to hike in May.
Yeah, exactly. That's where I was going to go. Real quick on the VIX. Kevin's right. If you look at the daily changes in the S&P 500, they have been pretty small, and that would probably
There's no
reflect
answer for a solid bottom.
19-ish VIX
Sure.
where we're at
You
right
can either
now.
wait for momentum to
What
go
I
up
was
and
kinda
buy in as
thinking,
it's going
though,
up,
is,
or just keep dip buying
we got
endlessly.
above 30
Your
with
call.
SVB in
There's
terms
nothing,
of at
nothing
the
bullish
height
about it
of
yet, though.
that panic, and
There's
the
always
market
divergence,
is
but
based on the VIX. It's
shorter
basically
term.
saying, okay, all that's done. We're good. It was just an idiosyncratic event with a signature, SVB, Credit Suisse. We're done. I guess, I don't know, and I don't think anybody knows. I'm just thinking that maybe there should be a little more premium as we hear from FRC on Thursday morning. But, hey, that's just me. Okay, back to Bullard.
Yeah.
Back to Bullard, though. Yeah, you look at the Bloomberg probabilities. We're up to, from 47% yesterday, we're up to 52% for a 25 basis point hike in May. If you look historically, that basically means they're not going to hike. And then you look at the additional months, and they're basically negative. So the Bloomberg probabilities are basically suggesting they're done. So there is still this discrepancy, this gap between what the market thinks the Fed is going to do and what the Fed is kind of suggesting. Or Bullard, we know, he can have some of those comments that can be a little bit more hawkish, but we'll have to see what they have to say. Again, CPI, PPI, we'll continue to look at the data. I think the JOLTS data is good in terms of helping the Fed's job there, in terms of, they can just pause and be okay with that. But again, we got to be careful that we don't get too much of a slowdown. We don't get too much of what we wish for. And I think the market is kind of contending with that great.
If you want to put more into it,
done.
I mean,
we want them to,
you can get your average below
completely off the pedal and
80
pause.
cents.
But let's
You'll probably be able to get
see
out
what happens in terms
break
of
even or profitable.
still getting the effects of the rate
You've
hikes
got
that have
get your
already
average
taken
below
place.
$1.
And the market is basically, discounting the fact
good
that
chance
the
you'll
Fed's
get
going
out.
to stay,
Break even or profitable.
up here near that 5% level for longer, Kev, into the
Well,
end.
Loretta Mester just told us.
But
And Bullard said the same thing
chance
this
that you won't.
morning.
Yeah, but more important than Bullard and Loretta Mester is Jerome Powell said the target is
Buenos
5.125.
dias.
That's one more raise,
Blue shell.
right? And then he can think about it.
Yeah,
if
that's
I'm
kinda what
Jerome
I'm doing,
Powell,
too,
I say I can raise one more time.
And I
to the
still might not
target
even
that I
buy.
said, and then I can come out dovish after that, right? And I'm clear. Now I've done the job. Let the interest
MCOM?
rate do the job. Do I think that's right? I don't know.
It's in the same
I
boat
don't-
as BBY.
I have no idea
Right.
what's right.
As far as their,
all come out at the
their
end.
chart and their split.
They're telling us they
haven't talked about
screaming
bankruptcy
at
at
us
all, though, have
that
they?
they're going to go higher,
Yeah.
higher than 5.
Right, and let that lagging data come to
Yeah.
fruition, because that's what I think a lot of traders
Yeah,
and
they did like a
investors are looking
spin-off
at, is that like,
and a
hey,
reverse
we haven't
split.
seen the lag effects of all the hikes that we had in 2022. For
This one might
it
be a
to
better one
equate
just to
lower
dip by.
Jerome Powell will be judged, Tom, on if it worked or not.
Yeah.
Now, not how we got there, right? If he stops too early and it plateaus at a higher level, his legacy
Those
is
financials.
gone.
Yep,
Pretty
soft
awful,
landing,
though.
hard landing, just land it. That's
Operating income is negative
Get it
16
on the
million.
ground.
It's only
All right,
pulling in
let's take
4
a
million a
quick-
quarter
let's
in
take a
revenue.
quick break here, guys. But when we come back, we're going to talk CrowdStrike, which is down about 8% so far this
We've
week.
been talking about
It's still
BBY,
up about
but,
20% so far this year after their investor briefing earlier this week. Fast Market's coming right back.
I mean, I don't think MCOM has talked about bankruptcy at all. Doesn't mean they can't just declare BK anytime, but. $364, you might also. I was just saying, for those people that want to average down, if you can get your average below those prices, your odds are increasing a lot. First split MBI when they try to reach that $1 billion. What? Oh, market cap. Wait, what are you saying? Oh, the agreement deal. I don't know. I don't know much about that, because they had so many different filings and then kept changing them, and then they had new ones and terminated old ones. It's just ridiculous trying to keep up, honestly. I'm much more just happy to look at the chart. Already been screwed a couple times on BY, just trying to follow the filings and trading on fundamentals and not on the chart. One was right here in after hours. They announced that first crazy warrants and preferred shares and basically pushed off bankruptcy for a few quarters, supposedly. And then it did this, and I closed. Had a break of that. That was a huge loss, though, because that was a huge amount I put in. Way too much. My own fault. And then after that, I've been doing TA. But you sprinkle in all this super hype on filings, which isn't hype. It means nothing. And you just get this false sense of bullishness.
We had Lumentum cut their guidance moving forward today in the tech space, but is this a warning shot that, hey, everything seems to be going well, but then
yeah, I mean, $1,000 buys a lot of BY shares now.
Hey,
It's crazy.
We're not
GME.
that sure, but here's our growth numbers.
Well, here's what I took from it.
Yeah.
last 3 years, the stock has grown.
Yeah, the
average of
WWE and their
67%.
merger
The
or
rest of
whatever,
the
it is kind of
industry
interesting. I'm not
45%.
following it too close.
Hold on a minute.
I'm not
because
specific to
in their
any stock.
Investor
I'm
Day,
just
their CEO, George
channel.
Kurtz, mentioned Microsoft 11 times
definitely
in
a
his
good
opening
trade.
statement. Why? Because
Made money on it.
Microsoft has this thing called
don't know
Defender
exactly what's going on with
software
it, though.
that's not the
They're like-
same, but similar. And
what
their
am I hitting? I can't
CEO did come out and say, in competitive deals, we win 8 out of 10 deals against Microsoft. That said, Tom,
merger with UFC.
Microsoft. They're Microsoft. Your competitor is Microsoft.
Right at that
That's a
$100
great
resistance.
for
So
your
maybe a
growth
good short here,
prospects.
honestly.
The
It's crazy as a
ability
dividend
for
stock.
Microsoft to
WWE
integrate,
gives you dividends. That's great.
into their whole ecosystem
Yes.
might be a warning shot. But Nathan, let's bring Nathan Peterson back in here.
I actually might short it here,
what
just
was your
being
takeaway
even
from some of the
$100
notes
level.
out of this meeting? Because the stock's taken it on the chin so
All-time
far this
highs.
week. And last quarter, they didn't guide very well. But this is, a necessity for corporations across the board. And with their Falcon technology, I mean, it's an industry leader.
Yeah, I mean, if you look at tech in general, now we've seen
Volume's
mega cap
wild.
tech done really well. They're perceived as a safety trade. We see a lot of money
Everyone's
flow
showing
there.
off my cost pages.
CrowdStrike
Yeah,
is
do
more
that.
in that longer duration asset.
More time
more
to
of
get
a
out?
growthier type name.
Probably, yeah.
You guys mentioned some of those growth numbers that they have there. And so I think it's really one of those situations where longer term, you look at the TAM, you look at the potential
BBBY.
growth in the total addressable market there for cybersecurity, and you look within technology, a segment where
How low that IV is.
enterprises will likely be the last in
It's
terms
pretty
of
illiquid.
cutting their budgets. Their IT spend is going to be on cybersecurity, so they're relatively defensive within that
grab it
space.
short on
So
here.
it just comes back to valuation here. And if you look at some of the estimates out there, it was about $3 or so next year that they're supposed to earn. That still puts you at the
Endeavor
higher
is
end
spinning
in
off
terms
its
of a
subsidiary,
relative
Ultimate Fighting
higher
Championship,
multiple. So
to form a new
if
company,
we go through some type
WWE,
of a slowdown in the
an
sentiment,
all-stock deal valuing a
around
leading
technology
professional
does
wrestling
shift
company,
because we
$9.3
do
billion.
see cutback in IT spend. I still think cybersecurity might
there's
relatively
100 on it.
outperform, but then they're still going to be susceptible to some of the sentiment
Well,
around
it
technology.
might not be a
in
good
general.
time. If they're valuing at $9.3 billion, it's only at 7.7
Yeah, I mean
now.
that's one of the
7.4.
concerns here. But a lot of people, I saw some of the analysts come out and they basically stated, Nathan, that this is probably worse than what a lot of the market's taking away from this. They're raising price targets.
Still represents an
from
enterprise
some of
value
the
of $9.3
companies.
billion,
But you've got an example
or
trade
106
to kind
per
of
share.
take us through, maybe playing the pullback here.
Yeah, so we're not around an earnings event. That's not going to be until late May, early June. You look at the stock technically. If you look at a 2-year chart of CrowdStrike, it's still in a downtrend. We know, though, also that 2-year captures some of the frenzy around growth and around.
Here's a
tech
pretty
we
interesting
saw
article,
during the
actually, from
pandemic. So you got to take that within context.
NASDAQ.
But technically, it
Deal
still
represents
has some work to do.
9.3 billion
The
or 106 per
200
share. That
SMA is
doesn't mean
still
that that'll be the final
downward
price. It's because the
sloping.
transaction will be an
So
all-stock
right
deal.
now it's
And
rallied
WWE
with
shareholders
tech
will
so
receive
far in
shares of
Q1, but,
the unnamed new
still
company
has
that will
some
be
work
publicly
to do.
traded
So
under the ticker TKO.
when I look at something like this, there's not really a catalyst.
Endeavor shareholders
on
would
the
represent
horizon
51%
per
of
se,
the
but I do
ownership.
note, hey, we've got
If
a
you're holding
3-day
WWE
weekend
shares, you're
coming
going to
up.
get shares of TKO.
That might lead you to say, hey, well, whether
Therefore,
I'm
the
bullish
final
or
sale price
bearish,
for
let me see if
WWE
I
will be
can
moving
somehow,
target
put
because the
on
new
some
company
kind of a
theory
credit
is already
strategy
publicly
where
trading
theta is
as
gonna
a
be working
combination
in
of
my
WWE
favor.
and a fraction of
If you're
Endeavor.
bullish on the name, we
Endeavor.
did see, 4
The company will
analysts
also
upgrade
issue a
their price
post-closing
targets
dividend,
yesterday
all
based on that
execs
investor
cash
day.
from UFC
And
shareholders.
you were interested in getting in a position, but you're just not sure about the timing. One way to do that is to go out there and sell the put. And so I was looking at something like just going to the April 21st standard expiration. You look at the chart and you could say, hey, the 50-day simple moving average is around 122. We've got a bit of a hammer today showing that there is some bid support that's coming in. Maybe that has to do with the 50 SMA we got within, $1.50 or so
On 1,000.
of that indicator.
Nice.
So if you're bullish and you're thinking, hey, I can buy it right here at 127, that's one way that you could get into the name. Another way would be utilizing options, selling a put.
Still doing
You've
merger
got a
before after
3-day
reverse
weekend.
split.
Right now, it's 16 days until expiration.
I don't know if they
When
have
you come
any
in on Monday, it's gonna
criteria
go
on
to 12
not
days
being able
until
to.
expiration. And so utilizing some time decay there, go out of the money. I was looking at something like a 120.
The vote for the reverse
It
split
keeps on
is the
moving. It's been
7th,
moving
I
up
think.
throughout the day, Tom.
Yeah.
So I've been moving
So,
my
or the
strike
9th?
up, but
So that's kind of
At the
interesting.
125 strike
that
for
they
the standard expiration,
gave so much time before
that's
the vote.
April 21st.
It's kind of bullish to me.
It was around
that they did that.
$3.30, $3.40. That equates to about a 3% yield on a cash secured basis if you don't get assigned. So meaning if the stock continues to rally or move higher here, we put in a hammer today, then you've got to say, I'm okay with walking away with 3% if I miss the stock that I will have within 16 days here. If, however, we do get a pullback and it goes below that 125 level, my net purchase price is going to be 122 rather than today's 127.50 level.
Yeah, the risk versus reward is
one way to kind of enter the stock
getting
if
better
you're
as far
bullish
as
and you wanted to establish a position and perhaps
investing
have
to
some time
BBY at
working
these
your favor.
prices.
Yeah, let's break this down.
Still very
Cash
risky,
secured
but
put here in CrowdStrike out in the April 21st
less risky
monthly
the cheaper
cycle.
it gets.
The 125 put we've got up here on the risk profile now.
Me at least.
We had looked at the 124 earlier,
Or is
but
it the
this
more
one's on the
risky?
125 put. You're collecting roughly a credit of about $3.25. So that's what you can potentially reward on that one. Takes your break even down to 121.75 at current price levels here. So you got that cushion, Kev, of about 3.5 to 4% below the current share price in CrowdStrike, and you have that ability to either keep that option premium, or if you're comfortable owning the shares at a discount to where it's currently trading, you do have some risk of over $12,000 to the downside if the stock were to go to zero. Yeah. But at the same time, this is a kind of a twofold trade. You either want to keep the option premium, or you're comfortable owning the shares at a discount to where it's trading.
Collecting about $14 a day in theoretical theta, long about 39 deltas, Tom. But remember something: when you do a cash secured put, like Nathan was talking about, it doesn't necessarily, even if the stock goes to 124, does not mean you have to take delivery of the stock. Mm-hmm. Remember, it's important that our viewers understand that. You can extend duration on this even if it's trading a couple dollars in the money. You buy that one, you sell the next one. And when you sell the next one, you can change the price. So you get to adjust the price. That's why this is such a popular strategy. Now, this is not cheap strategy, right? You do have risk all the way down to zero, even though you can debate that.
Probabilities are against that.
Yes,
yeah.
But there is a chance that it could go down to that level. It was just $92 at the bottom of the rally. So there is risk on this trade, but this is an effective way to, instead of putting in a 125 bid and
breaking out to the upside,
missing it and not getting it,
this level.
you can do this and wait, right? And then earn money while you're waiting for it to get down to that
shorts
level. And when you do that, the break, your entry price will be, like Nathan said, $122.
Right. Yeah, that break-even point, and
sucks,
the market open liquidity provided the ability to roll or adjust this type of position.
And I knew this was coming
fall,
too.
But you do have that assignment risk into expiration over the next couple of weeks here. But a good look at a cash secured put to take advantage of the downturn as an example here.
Before I close.
All right. Thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research, for joining us today. But coming up after the break, Kevin and I are going to be joined by Landon Swan from Lightfolio for a discussion on home improvement retailer Lowe's, which is relatively flat so far this year.
One of us. One of us. It won't hit 7. It very well could hit 7, man. Very well could. Without a split. No trickery. Just look at the chart. Look what it's done. I think all these months it's selling off from 30 down to $4. They weren't thinking the same thing. At $8, like this has got to be the bottom. It keeps going down. It's like 4. It's like, wow. People here were saying, oh, it could hit 30 again. Like, no. Hit a double bottom. Hit 30. Same deal happened here. Grinded all the way down. Buy, almost getting a new high. To $1.27. This was like big gaps, big drops. And that one hit. $7. So 7 from here definitely would be more, but buy new high on the day, and it's ripping. Off 7, it's 27. Is that high? Permabull, this is the floor. No more downs. It's guaranteed. Only ups. It's done that little after hours rally before. I don't know. I don't think it was from that reverse split news necessarily. Did notice that. Doesn't mean he wants to sell. Don't bring it up, Ace. It's a very dark moment in my trading history. SPY freaking squeezing. He's just saying that he wants the right to sell. Not going to sell. This is bullish because it means it's gonna rip so much at some point he's gonna want to sell. Not that it just ripped 500% and now he wants to sell. Why would he sell after it ripped 500%? It just went from $4 to 30. Does not mean he's gonna sell after that move. It means he's gonna sell because but it's actually made a real move to 140. Not now. Not now. Jeez, I don't know if I want to hold through this. This is yesterday's high. Not high, but this little peak from yesterday's at 409 area. 409.13.
Generally speaking, if you're talking about renovating your home, you're more likely to go to Lowe's. I mean, you might be going to Home Depot, but you're more likely to be going to Lowe's. So this is a big part of their customer base, and it's falling off.
I remember even talking to someone on the phone.
On a year-over-year basis.
No, dude,
I mean, there was that nice
didn't
bump
sell.
back
That was
in
FUD.
COVID
They're
times
trying to
when
just
everyone
spread
kind
this
of
room
did
that he
something.
sold. That was just a filing for an intent to sell.
Then. But this
Yeah,
is
it's
still
totally
year-over-year. This is not year-over 2020, so it's still down on.
It's not going to sell here. It's only at 30.
A
It
contractor
was at 4
mentions
2 weeks ago.
people
I
talking
know,
about
but it's only
hiring
at 30
a contractor.
now.
That's actually
He's
up
only
about
green on the
10%
position that he's been red on since he opened it.
So
It's not going to sell
that's going
now.
to bode a little bit better for Home
Just an
Depot.
intent.
Now, obviously, it's not just contractors that go to Home Depot. They would prefer home renovation is up as well.
And I'm all jacked up on Mountain Dew.
But if you had to pick between these two, obviously the data is coming in a little bit stronger for Home Depot. Both of them are weaker on a year-over-year basis, but both of them, and if you look at compare and
they're all
contrast,
under the
Home
same
Depot's doing a
company.
little bit better, pretty much
So
in every
it's
category.
all of it going
And
bankrupt.
actually, if you
Bankruptcy is a
extend that
protection,
to the
so
stock,
doesn't mean they can't keep trading.
I'm a little bit of
Doesn't
a
mean that's
contrarian. So if I'm thinking about getting in something
continue to be
long,
a
I'd
business
rather
and
the
keep their
stock
stores
be
open
down.
and
I don't want to buy
restructure.
at all-time highs. I'd rather get a little dip in. So Home Depot is down about 6% over the last 3 months, whereas Lowe's is up slightly, maybe plus
SPY is
2%.
ripping?
So
I
it's
don't know.
actually a better buy right now than it
maybe
was
just
compared
because
to
it's been selling off the last couple days
to
and-
Lowe's, which is, as you guys mentioned, it's pretty much flat and consolidating, but
more or
you know,
less
down 6%
flat.
versus plus 2%. There's a
Down and
small
up,
difference there.
but flat.
So
Waiting
all
for
in
data
all,
tomorrow.
you know, we're a little bit bearish on Lowe's, and I wouldn't say
Not
we're
liking
bullish on
today
Home
if this
Depot, but
engulfing
if you
candle
have to
completes
pick
though.
one of these to put an investment into, I would
Would
definitely
make me
lean more
think we're
towards
probably
Home
going to
Depot.
break this high. Maybe
And
not.
I understand the competition.
break
I
through this,
understand
but-
that Home Depot's the leader in this.
Yeah.
But if you look from an opportunity standpoint, you know, you can tell that Lowe's is starting to concentrate on this contractor. 11 straight quarters, their pro business is up double digits. My contention is that you never stop working on your home, ever. And 50% of the homes in this country are
Yes,
more
it's
than
the same
40 years
company.
old. And you can make a case higher interest rates equals less people moving equals more people working on their homes. And I get the dip in these names, but this is destined to be cyclical and destined to come back, right? So, believe me, Lowe's has earnings on the 23rd of May, Home Depot on the 16th. You got to trade them on both those dates because they're going to move in unison. But don't you think that 25% pro-business that Lowe's has versus Home Depot, I see that as an opportunity for Lowe's if done correctly.
Yeah, I think so. I mean,
Good afternoon,
it is an opportunity.
Jonathan.
There's only upside there. And I think they've taken some steps towards that. I mean, they talk about it in their last earnings report. They know they're way behind on that. And so they're going to try to catch up. So I would say that you're right. There is an opportunity there. But, you know, they both were in this spot, 5 years ago, 10 years ago, and look who's done the dominating. It's been Home Depot.
No, Jimmy, it's been a bull flag.
There's an opportunity, but the opportunity is there because they haven't executed very well when
Problem
it comes
is,
to Lowe's attracting those professionals and the contractors.
That support of the bull flag
yes,
broke yesterday.
They could take off.
Now not a problem.
As far as the home renovation, I mean, I agree. There's some old homes out there. And there's not a lot, based on interest rates, not a lot of people are moving right now. I mean, if you took your house and you went and moved to the exact same price house,
I don't know what you're even talking about now,
like
Flavor.
20, 30, 40, 50%, depending on where you got it, because interest rates are just so much higher. So moving right now is not great. Liquidity's down on homes. So people are stuck in their homes. But I think a lot of the home renovation was done 2 or 3 years ago, either during COVID when everyone was stuck inside and they were looking at the same carpet, same walls, and they did a lot. We had a huge spike in home renovation during COVID. And then during that big move, when everybody decided to pick up and move and all the homes were selling in summer of 21, every time somebody bought a new house, immediately the first thing you do is you want to change it and renovate it. So I think a lot of those bullets have been fired, right? I really think that a lot of the home renovation that's been done or that would be done has already been done. So until people start moving again, or it's just been a long enough period of time since that last one, and you can say, you know what, those colors we picked out in 2020 are looking stale, let's get something new. Until then, I think that home renovation is likely to stay down. And so it's very important for Lowe's to cut into Home Depot's lead on the professionals and the contractors.
Yeah, and on the back of that, information about home renovation, I think people need to pull back on travel experiences and going out to eat, because that seems to be the only thing that's expanding right now, Landon. But with Lowe's relying so heavily on the do-it-yourselfer as opposed to the professional business, Kevin mentioned they've got an opportunity there, but Home Depot continues to eat their lunch on it. Is that the concern where, hey, I'm not going to redo my bathroom, I'm going to go take this trip down to the Caribbean instead? And that seems to be what people are doing, and that's going to be the problem for Lowe's in the near term anyway.
Yeah, I think so, because if you think about what people were doing in 2020 and 2021, they were spending money on their home and they weren't going on vacation. So now we're out of that, and you're going to do the thing that you missed and that you haven't done. So I think that people are more likely to spend money on on experiences, going out to eat or on vacation, things like that. So I agree. It is upside, though. I mean, I think Kevin has a great point with the upside on the professional side for Lowe's, but it's just a big uphill battle because these guys are very, very loyal, and Home Depot's been taking care of them. So why would they switch? It's an uphill battle to get them to switch over. If they can do that, then yes, then Lowe's is going to perform fantastically. I don't know if that's going to be the case, though. I think that just history shows us that Home Depot's been, like you said, eating their lunch. So what's going to change now? Like, they know that Lowe's is coming after them, so everything that Lowe's does, they can match. And so I just don't see it happening. But I'm not an executive at Lowe's. Maybe they know better than me. Maybe they have a better plan than I think.
Yeah, and the fact that I can now get a contractor relatively easily as opposed to a year or two ago, that might be a warning signal also. All right, great data as always, Landon. Have a great weekend.
Thanks, guys. Take care.
All right, that's Landon Swan, co-founder of Likefolio, breaking down the data for us on Lowe's here. Now, to his point, the data is starting to soften, right? Year over year a little bit. But at the same time, the stock's done nothing for 52 weeks here, Kev.
Right.
So how do you want to look at this? As you mentioned, they don't have earnings for over a month.
Yeah, May 23rd, and Home Depot's is the 16th. You got to pay attention to both those.
Right.
I stayed way ahead of that, Tom, and I did something almost defensive. on this trade. Why? Because I looked at this 190 level and look at all the touches right around 190.
Bye Baby is not Ryan's
Tom,
company,
and
no.
I think Home Depot could go, or Lowe's could go up, it could go down, it could go either way based on the market. So all I did was get to a favorable level and sell a put vertical. So I went out to the April 28th, and this spread had a little more premium in it about an hour ago.
Yeah.
But now it's trading about $1.20, $1.21. I sold the $10 put vertical, 190, 180 put vertical. It's about a 72% is what it was as we walked down the air, probability of being out of the money. But this isn't a home run trade, but if I'm going to trade lows between now and then, I want something that maybe the stock could come down and still be okay on this trade. So 190, 180 put vertical, trading about $1.21. Like I said, it was trading a little higher earlier in the day. It's about a 14 delta, collecting a little
This
bit
is
of
a
theta,
website.
but high
Ryan
probability.
Cohen owns it. It's called
Short
Teddy.com.
put vertical, a little bit more
sells
risk
books
than
on
I'd
here for
like to,
children.
$10 wide.
This has nothing to do with Bed Bath & Beyond or
this
Bye
is
Bye
one that
Baby.
at least I know that my short put is at a safe level.
Yeah, and we've got the risk profile up here at $1.40 credit, which would take down your break even down to 188.60. It's trading closer to 120 now, so your break even would be 188.80. But you've got a 75% probability that it's out of the money at expiration on this put vertical. Going out to the April 28th weekly series, selling the 190 put, buying the 180
influenced
strike
a little
put,
too much by
neutral to
Superstock.
bullish, $10 wide put vertical. Now, if you collect
Reddit in general.
$1.20 or
Yeah, be careful.
$1.40 on that, your risk is going to
start
be
confusing
about
stuff like that.
$360 to $380 per spread based on what price you would get on this example. You have some assignment risk on that short 190 put. But I think this is one of those more conservative, in that baseball analogy we refer to once in a while, hitting a
UVTL
single,
2.5.
hitting a double
Right.
when you have,
Yay.
a directional
Waking
bias
up a
on a
little bit.
trade, selling out of the money
And the
verticals.
stock has rallied a bit today. It traded 195.5. Now it's up over 199. So this looked a little better. It was right around 71% when we were down there. So yeah, now it's up to 70, almost 75.5%. So that trade-off is higher percentage, lower premium.
Right. All right. Great look at the example short put vertical. That's neutral to bullish in nature on that
409.
example. All right,
Buys
Cal,
up
we're going to take a quick break
0.3%.
here. When we come back, we're going to talk another retailer. That's
Big
Target,
intraday
which has
candle
rebounded
again.
about 9.5% so far this year, but still down
Huge
significantly
engulfing.
over the last 52 weeks. Fast Market's coming right back.
I don't know if it's going to happen today, but if we get a big engulfing candle today, I mean, we're still waiting on that data tomorrow, but I guess I'd like to see a break of this level before I'm thinking we're going to go long. I'm going to be down on my shorts. Very shortly. Very shortly, dear Watson. Well, if this data tomorrow is bullish or causes the market to rally, missed my exit on my shorts. Everything. Crazy. Open up a position for like a month or two, and your exit on it was maybe next day or day after. Yeah, I sold some cash grade puts on Rivian yesterday. A little scared about it, but chart still looks nice. I really don't like the company. Not something I'd want shares of, so it's kind of risky. Costco, BBBY. Yeah, from this morning, I mean, BY had that big flush. AMC is pretty big. This flush this morning was massive and fast.
Say Uber, for example, people looking into private driving, which is still, I'd say, a competitor to Uber, but is it really Uber? No. So, I mean, I have my own feelings about this. Some of the, I would say, notes of this were interesting, like professional property managers do account for about 1% of all vacation rentals on Airbnb, but they handle about 23% of active listings, which produce about 35% of the company's overall revenue. But according to the short seller, Airbnb's future will look a lot different than its past because the company will now need to compete against
Thank you, Ace. Appreciate your membership gift.
So there's that, and then
Anybody
there's all these horror stories they list, like various
taking.
deaths or parties that got out of hand, which I would say compare that to any hotel's incident report. I'm sure you'd see similar things.
Recipients will be chosen by YouTube for membership.
At a various type of away experience.
Looks like Spy might be rejecting that line. We grew up there.
I'm a little bit skeptical on this because I do think there's a trust, there's an ease in booking with Airbnb, and there's those that are loyal to Airbnb that like their experience that will continue to go back to a platform that they've had good experiences in. I think so much of tourism is built on loyalty. So I guess we'll see. I think this is interesting, but I do see some holes in the short seller report, Tom.
Yeah, definitely. And Bernstein already came out with a note kind of pushing back against it, following this short report. You know, the thing that bothers me, Jenny, and there's one thing, and that's the fees.
I knew you were going to say that.
The fees are just astronomical. It's crazy how much fees they put on these places. So,
but you pay fees at hotels. You end up paying like taxes in the hotel that
what
you're staying at.
What does a fee matter?
You pay those same fees
just
at hotels.
The end cost. No matter
not,
if it's a fee or the rate.
It's presented to you in a different way.
Yeah, we'll battle after the show on this hotel.
Free room rental.
I'm team hotel, okay?
You just pay all fees.
Right. All right, thanks to Jenny Horn breaking down the news story here on Airbnb as the stock's down over 3.5% during today's session. Now let's switch back to the retail space. We're talking Target, so let's bring in Kevin Green, senior markets correspondent here on the network. Kevin, we're talking Target. Stock's rebounded here a little bit so far this year in 2023, but it's been a rough ride as this company tries to get through inventory issues, and now you're seeing some pullback in discretionary items, which has kept a cap on the shares.
Yeah, definitely. I mean, obviously the discretionary side, I think, is a little bit more of a bigger impact when it comes to this company here. They have been able to target a segment of the consumer base that has a little bit more discretionary income. But if we are seeing a slowdown across the board, those consumers are starting to trade down. And we have actually seen that type of result here when it comes to Walmart's earnings, as well as Target's earnings. They actually do mention that here. But I would say, Tom, they do also have an opportunity when it comes to their private label business. When you look at their prices compared compared to Walmart. They actually are a little bit comparable here, which is giving them a little bit more of an out. But the grocery side of the business has been the growth driver for Walmart, and Target just does not have that exposure. It has about half of the exposure to the grocery side of the business than Walmart does. Now, we know that grocery does provide a lot lower margin. Usually within that business, you see a profit margin between 7 and 9%. So we know that it's not going to be something that grows over the long term. But when it comes to Walmart, they have been able to compensate the losses on the discretionary side, especially
FOMO is like
ticket items. If you're looking at
FOMO
TVs, or if you're also looking at
Tesla or Apple, it's not real FOMO.
equipment, things of that nature. So it's just something that's been an uphill battle for Target, but they have been able to work on their inventory, and they have been trying to adjust their inventory mix here and try to streamline the business a little bit when it comes to trying to provide products that consumers would want and need. And if they can continue to see improvements on that side of the business, it'll help them scale. Now, last but not least, from a technical standpoint, we can always have this conversation of should they have been trading at the levels that they were during the pandemic. I think that is a little bit questionable here. During the pandemic, they were trading at a 23 multiple during 2021 and 2020 here. That is very outside. That is outside of their average range, and usually we see the range between around 12 and 11 to up to about 18 and a half to 19. And right now it's trading at an 18.3 forward multiple. So you could also make the argument that it's at its upper range compared to its average over the last 10 years. And so I'm not sure if the goal right now is to try to get back to those highs, if you can justify those highs. I think right now you have to be able to try to provide profitability in a stable business and try to assure investors that your inventory mix is going to be something that consumers are going to want to desire, and you can change on a dime. This is not the first time they've been burnt by the lack of inventory or build up in inventory.
Yeah, the company announced that plan to try to kind of fix those inventory issues over the last couple of quarters, because it was just 11 months ago when this stock just cratered based on what was happening there. They had too much inventory of products that weren't selling. They had steep discounts and promotions also, but trying to work through that. All right, great stuff. Thanks to Kevin Green, Senior Markets Correspondent here on the network, breaking down the backdrop here on Target. Kev, one of the reasons I want to talk about this, because it's in the retail space. MasterCard came out with some data, said that March sales were up 4.7%, but they're switching more to staples as opposed to discretionary items. And the key thing, the takeaway that Walmart had their analyst day earlier this week. I've seen so many price target hikes across the board in Walmart this week, including like 3 today. Target's getting no love at this point. Your thoughts here on Target, as it's it's still down pretty significantly from year-ago levels.
I think the key qualities for Target is, their ability when they bought Shipt in 2017 was incredibly well timed. I think the Ulta move, 350 shops now in their stores, going to 800 shops in their stores is going to help this company. By the way, they don't just have a partnership with Ulta, they also have it with Starbucks and Disney and Apple. They have high quality, high profile relationships. This omni-channel with a little, let's face it, a little higher quality overall experience than Walmart is still going to have its niche in retail.
Yeah, and Walmart focused more on the grocery business, which kind of gave them a leg up a little bit too. So
they need discretionary to get more popular again.
Exactly, and we're just not seeing those signs. But I wanted to look at a strategy that goes off the back of all the price target hikes that we've seen in Walmart. Maybe we're going to see some green shoots here in the retail space going into earnings, but avoiding that earnings event. Kev, so I looked at a bullish example here to take advantage of a potential move to the upside here while limiting my costs. So, Kev, we're looking at the May 5th weekly cycle. So just under a month, 29 days till expiration. We're going to do an unbalanced call butterfly, where I'm going to buy one of the 162.5 strike calls, slightly in the money, sell 2 of the 170 strike calls, and then against it, buy 1 of the 172.5 calls. So you're buying basically a $7.50 wide call vertical and selling a $2.50 wide call vertical to make up this three-legged spread. You're paying roughly about a $3.10 debit for it. There's your risk, $310. But Kevin, this is a type of strategy where you're offsetting some of your costs. You don't need the stock to explode to 185, 190 to get to profitability. You only need the stock to go to up to about, 165 and a half, 166.
Yeah, but here's the good news. It wouldn't hurt you if it did do all that.
Yeah.
Right? If you set up this butterfly the right way, you don't care how high it goes. Now, there's an optimal place,
right,
but you do well on any upside move. And so by buying a $7.50 call vertical, selling a 2.5, you get where this is leaning, but you've got that butterfly component where if it goes to 170, you're short 2 of those. And you can get the max on the one spread and 0 on the other. And that's where you get that peak. That being said, you do need movement for this to be successful.
Yeah, if it does settle around that 170, the potential for profitability is more than a double on that one. But even above that 172.5 strike, you're going to be profitable on this one. Your break even, I mentioned, it is 160, about 165.5 on that spread, but it's a bullish way to look at this, but you're giving yourself about a month's time and duration. Maybe you get some positive commentary on that, but just an example here on a bullish, unbalanced call butterfly. All right, that's going to do it for Kevin and I today on Fast Market. Stick around, though, right here on the network. Next Gen Investing's up next.
All right, it's almost 1 o'clock. Got the vacuum going again. Hey, you know what it is? 1 o'clock. That's subscribe hour. If you haven't subscribed, if that button just so happens to be red, click it, turn it gray, hit the notification bell, turn that thing on, ring-a-ling-ling. It's 1 o'clock. Let's get some subs. Let's do it. Just because you saw me here today and every day doesn't mean you're subscribed, so make sure you are. SPY is coming down. Person buys out Bye Bye Baby. Well, that's what all speculation is, that there'd be a spin-off or a carve-out of Bye Bye Baby, where Bed Bath & Beyond would just sell Bye Bye Baby. And if they did that, they could probably raise enough money to pay off all their debt. So then you're looking at a company, they'd want to get cash flow positive, but if they paid off all their debt, you're looking at a company that is making $1.5 billion a year in revenue, or a quarter rather, and they're burning cash, but if they didn't have debt, this balance sheet would be much, much better. And that balance sheet maybe has already changed. We'll see the next probably 2 earnings, I'd say. Their operating income should come down significantly, but the revenue will probably come down some as well. Well, SPY flushed. That's not even a flush. Sub, belled, and thumbed. Thank you, Christopher. This nice and cash secured puts. Yeah, it's so far from this level. I'm curious if it even retest this. If it does, what happens? Up is up 9.3% now. Very interesting. It's not even near VWAP. The options don't change that much though. The fill you could have gotten here is probably just about the same fill you can get here. Oh, I hate GME options. Revenue come down due to foreclosures, right? Right. Yeah. But that's all being said without their debt. I mean, yeah, they can survive and make it with all that debt, but I was just saying under the pretense of if they sold BBBY Baby and paid off all their debt, then even where they're at right now could be quite a viable target for someone to invest in or even take over. Or... I don't know. Look at the fills. Look at the. I don't know what ones you're looking at, but I hate GME options, man. If you're looking at like monthlies, let's say April. Would you have like a delta you pick, like a 30 delta or a 25 delta? So let's just say $20. Look, this thing has just lost value today. This put has only lost value. This is today. See what this was this morning? 34 cents. Now it's 19 cents. Let's see what the chart did today. How does that look like compared to the chart? Isn't that strange? The chart's actually gone up. Why has that put lost value? Because of the volatility. Oh no, it's gone up. Never mind, that makes sense. We're looking at the last little bit though. So like 18 cents, 19 cents. It hasn't really moved a whole lot. It's actually gone down. 12.45. So 19 cents, and now it says it's 18 cents. But you're not going to get any different fill from there to there. Not a big enough move. That's right. I've heard they had to use BBBY for collateral for one of their loans. I don't know if that's true or not, but I forgot about that. If that's true, then yeah, they can't sell it off. They can't carve it out. None of that can happen, which would kill a thesis for a lot of people of why they even own it. Because that was the reason a lot of people bought into it. I haven't confirmed that with a filing though. I don't know where that came from, but. It very well could be, and it would make sense that they've just leveraged any asset they had that was valuable. Or they wouldn't be close to bankruptcy. Because if they have this asset that's worth a couple billion, why are they going to file for BK? GME, yeah. I mean, the more time the safer. It's not like you have to nail the timing on it. Buy bouncing up here. I got April's and I wish I got May's. I think this move down to 1940 could happen this month. I think it probably will, but I think it could happen the next week actually. But I want plenty of time. I didn't get enough time. Because now, from when I bought them to now, they're down 50%. Just in that amount of time. And I got them at the money. They were 21s. I got them there at the money. Yeah, that doesn't make sense to file if they were able to sell out or carve out their BBBY Baby brand. So that could be true with the collateral thing. There's a flush on BBBY, back below VWAP, down 9.2%. Back to the lows, see if it finds support here. I do actually have an order to buy calls again. I'm not sure if it'll fill. But maybe I'll get a lucky fill.
was during the pandemic. But they said that downward revisions now to their third quarter remains likely. But they do actually recommend, this is from Baird, that investors look opportunistically at pullbacks like this in a name like Costco because they're now better positioned to weather some of the choppiness we are seeing in the overall consumer discretionary environment. So they actually see this as an opportunity to get into Costco shares, even with some downward revisions coming to the next quarterly update, Alex.
Yeah, I liked how they put this. I'm going to say downvote, though, for Costco, just because this sort of mini earnings event is now over.
Right,
we get
7%.
sort of these every single month when it comes with Costco. But I think this is a fascinating-looking chart. This is one that I'd like to come back to at some point in the future with Rick, and maybe on a longer-term time frame, because it was extremely volatile, and it's almost as if it's getting less and less volatile, but sort of in the middle of its range. So pretty interesting one, though. I think Baird put it very well in sort of reaction. Going to say downvote, though, today. Let's talk some Lumentum. This is a pretty sizable reaction to the downside here for a market itself that is pretty quiet. Clearly news-driven here today, and disappointing news at that.
Lumentum, I don't think we've ever discussed this name before on the show. I frankly don't even know if I've ever actually looked at this name beyond its ticker, which is a great one. It's LITE. But shares are down almost 10% today in reaction to the company updating its third quarter metrics. They lowered their sales expectations, cutting their third quarter revenue view to fall between 380 and 384 million. That's down from 430 to 460 million, so that's pretty substantial. And the CEO did say that late in their third quarter, a network equipment manufacturer who represents more than 10% of their second quarter revenue informed the company that due to their inventory management, they would not be taking shipments they had originally projected then for the quarter. Now, Ciena was the company that was blamed for this shortfall. Shares are also lower in Ciena today, but CEO did note that this shortfall is primarily the reason they're seeing now their third quarter revenue coming in at the low end of their prior guidance range. I'd say low end is putting it lightly. They are nowhere near the previous guidance they laid out in terms of revenue. But looking ahead, they do now expect a similar level of shipments in the fourth quarter as they're now seeing for the third quarter. I think that's also a pretty significant problem, the fact that you're not only seeing this issue then persist for this upcoming quarter, but also a remaining headwind now for several quarters away. They did also increase their share repurchase authorization to $1.2 billion from $1 billion. Not enough to lift shares at all, though. We're seeing analysts react to this. Barclays, UBS, Morgan Stanley, Stifel, and Raymond James all cutting their price targets accordingly.
Yeah, and this is one of those situations we're still a little bit over a month, I believe, out from earnings, and so this may take some of the
losing viewers if I don't leave Jenny on the screen.
Sort of gotten wind that it's going to be a disappointing quarter. But there's still enough time for there still to be some surprise. So obviously the company coming out and saying this is going to affect the stock price. You see the reaction. Certainly disappointing news, though. If you're expecting, a midpoint around 445, and now your new midpoint is down in 380s, it's a pretty substantial difference in that revenue target. So I'm going to say downvote. Again, very similar to Costco. This is sort of, in a way, the earnings now breaking. Of course, there's going to be opportunity for this to subtly adjust as time rolls on, but for the most part, we now basically got the news.
Bouncing back up here.
To it. We'll see where things end up. I'm going to say downvote. Next one on the list, though, is Wells Fargo. Financials have been very much a big part of the story, and these big banks have been seen in many ways as sort of the beneficiaries of all the uncertainty.
No doubt. And Wells Fargo, it's nice to talk about banks on a day when they're, at least Wells Fargo is higher significantly. Actually, our best performer of the group, up just shy of 3% on the day. Raymond James did upgrade Wells Fargo to strong buy from outperform, with a reduced price target, however, to $47 a share, down from $52. And the analyst sees now several incremental positive catalysts for the bank going forward. They noted that as a systemically important financial institution, Wells Fargo will be a major beneficiary of the SVB Financial and Signature Bank fallout. They said with uninsured depositors across the country now fleeing to larger and safer institutions, the firm does expect incremental growth in Wells' deposit base. Additionally, they believe that Wells offers greater earnings growth potential over the immediate term, given the possibility of a removal of consent orders and the associated regulatory expenses, which amount to billions of dollars every year. This is fascinating. This is the narrative I feel like that hasn't been discussed far enough, because we focus on the banks that are failing, the banks that have issues. We don't focus on the fact that this is not a one-size-fits-all sort of issue right now with the banks. And what a different tone we're hearing in Wells that has had its own issues, Alex, stocks for several years to hear this analyst be so positive on this name.
Yeah, and the funny thing is too, as you mentioned, sort of the different banks reacting differently, maybe have differing exposures and different significance as measured by the market based off of size. This stock is basically sold off a good 20% or even more so in very short order. So you'll notice within this particular reaction from Raymond James, they do upgrade the stock from outperform to strong buy. They like it more, but the price target's actually lower, which I always thought was interesting. So it's acknowledging that the stock's been affected by what's going on, at least in terms of stock price. Going to say up out though, we very rarely talk banks, and no better day than today with this pretty positive note from Raymond James.
No kidding. I need to talk about the banks in an optimistic way because I'm tired of this very negative financial narrative. So we'll be moving forward today with our two upvotes, those being Pinterest as well as Wells Fargo, both higher on the session. We'll be looking at some charts as well as some example trades coming up next.
Overwhelmed by the grades.
In the social media space.
The chart hasn't been looking too bad either. It's been kind of just grinding upward for a while here. And you can see that we've been traveling up in an upward channel type pattern here. Kind of messy though. We've had some breaks to both the upside and the downside from this pattern here. But we're back within it, kind of in the middle of the range here. Today's candle is looking pretty decent. We're up about 2.7%, near the highs of the day as well.
We're only left with the cursed.
Some important moving averages recently during our most recent up move here. We crossed above all three of our 21-day exponential moving average, our 63-day, and our 252-day here. So looking at the point where we topped out, though, it's seeming like perhaps our upward channel is transitioning to a bit of a sideways range here between about 23 to the downside, this green dashed line where prices bottomed out here and once again here, and then to the upside around 29, this red dashed line where prices topped out here and here. So we can see now that we've got the beginnings of an established zone for price action here. And we can see as well that, you know, we haven't really made much progress beyond either of those areas except for some intraday fluctuations there. Looking at momentum, RSI, not showing us too much in the way of clues for eventual price action, mostly just following where price is going here. We are still tilted toward the bullish side of things, but we are not really anywhere close to the overbought area or to the midline here. So not much of a lean one way or the other, just kind of trending upwards still with price. Looking at our resistance and support here, we can see an interesting point right here. That's our purple 252-day exponential moving average and our yellow 21-day EMA coming together right around the 27 mark there. So that could be a significant point to watch for some support if price starts to move lower. If that's broken, our 63-day EMA comes in just below around the 26 mark. To the upside, 29 is the place to watch still, the red dashed line here. Beyond that, the top of our channel would come in right around probably 30. So the main price levels to watch, I would say here, 23 to the downside, 29 to the upside.
29 to the upside and a more near-term target to look at than we did get from Raymond James, which is $33, obviously implying that 12-month outlook. But now when looking at trading this name for example purposes, of course, Alex, walk us through what you're thinking, leaning them more bullish in nature, because like Rick said, things from a technical perspective look pretty promising. This name hasn't necessarily been, you know, hugely outperforming, but up over 15% year to date, only down from its highs by about 4% now.
Yeah, a little bit of outperformance on the technical front, at least trending higher, but also really positive words from Raymond James, I think is the crux of the idea here for the potential bullish trade illustration. What I looked at was simply just buying a call vertical, looking at a strike in the money, selling a strike out of the money, trying to get the break even near the current share price. So for this example, I did go out to the May expiration. This affords a little bit more time till the expiration date, and by doing so, you can actually have a little bit wider profit target to the upside here for this one. So I looked at a 26.30 call vertical with a break even at 28. The stock currently trades around 28. You'd have that 28 break even by looking to spend just $2 on this particular spread. $4 wide, $2 debit is 1/2 the width of the strike, so $200 in risk on this one for a possible reward of also $200. Neither accounts for the transaction fees, but I think the risk profile here does a good job of illustrating just what you'd like to see happen with this type of a trade. Where that white arrow represents the break even, we said what's pretty close to the current share price. You can see kind of no harm, no foul if nothing really happens and the stock just sort of stays in this area. However, if the stock price increases, you do see, of course, profit capped out above 30. And then to the downside, it does cap out the losses around 26. So straightforward, equal risk, equal reward, Jenny, looking for upside in Pinterest.
And now also another name that is seeing very similar strength today, that is Wells Fargo, a welcome to move higher. Chart looks pretty different, Rick. I will say, though, this name is down on a year-to-date basis. No surprise, closed the month last month lower, but
that's my keys typing.
Oh,
you're my vacuum.
Sounds
like me snorting code.
In the bank, at least
earlier they said it sounded like a fire extinguisher.
Well, the price target was pretty optimistic. That 47 price target is about 23% to the upside, and basically just assuming we'll get back to where things began before we had the start of all these troubles. 47 is this blue dashed line right here. And you know, it's been a pretty dramatic slide though. We're down about 19% since the start of this down move here. And it's, you know, there's not a ton to say about this one in terms of technical activity. We bottomed out close to the previous lows around 36.50. That's this green dashed line right here. And you can see that we had a downward excursion all the way back here in late May. So that's the point that many traders probably had their eye on if they were looking for some support around that area. We did get a little bit of a dip below that point. We bottomed out at 35.25 here, but we did make our way back above that green dashed line representing 36.50. So that's a point to watch to the downside, a line in the sand potentially. And the move downward stopped in a place that you might have been able to make an educated guess that it would start to find some consolidation there. We stopped near our -2 standard deviation channel. That's this orange almost horizontal line right here. Standard deviation channels, we take our blue linear regression line, our line of best fit, then we just extrapolate channels to the upside and the downside based on standard deviation. So this tells us that the move we're seeing is fairly extreme. We're down, -2 standard deviations. Stocks typically, anecdotally speaking, just based on my own observation, don't go too far beyond -2 or +2 standard deviations. So this move perhaps could suggest that we're on the verge of recovering a little bit in this name. So to the downside, if things do continue to worsen, if we get some other real bad news or something and the situation deteriorates, the -3 standard deviation channel comes in right around 34. So bad news out of the way first. Hopefully we should be okay here because as well, the momentum, the RSI is trending upward here. We kind of fought our way out of that oversold area. We're making new highs with price and we are still short of that midline that would suggest that crossing above 50 would be a return to bullish momentum. Still tilted toward the bearish side here, but improving. In terms of resistance,
I looked at
right
getting
here, our
a
yellow
mic
21-day EMA
arm. I don't have a
at
mic arm installed on the stand, so it's literally like
right around that 39, let's call it, could be a point to watch to the
I think
upside.
sick
Beyond that, we've got
ASMR
our
freaks out there like
-1
it, so
channel,
I just
which
leave
comes
it.
in right about at 40.
Yeah, and like you said, this name
Maybe
trades
get a
in
bounce on
extremes,
VWAP,
Rick,
SPY
because we know
consolidating
from
up
the
here,
slide we saw,
making
we're
me
still
think it
hanging
wants to
out
go higher.
relatively lower since some of the weakness
Maybe
we've seen.
409,
We've been unable to recuperate some of those losses. But the banks have been trading with extreme volatility, but perhaps areas of opportunity like this analyst thought. But we'll leave it there. Appreciate all of your insight. As always, Rick Ducat, our chart master. So Alex, when looking at Wells Fargo, really following this analyst note for some example purposes, obviously it depends on your own conviction on the overall financial system. But they have a $47 price target. And I know that was a reduction from 52, but a strong buy rating, $47 does imply still about $10 of upside. So walk us through your thinking.
The short is, man?
Strong buy. Just I think if you have that sentiment, I got a strategy that looks to accomplish just that. We've looked at this quite a few times over the years, Jenny, but I think still a strategy that we don't look at quite as often.
Yeah, I
as
know.
some
I do have it kind
others.
of.
It's called a call zebra.
Sometimes it's hard for me to tell because I have
referred
background
to as
noise.
a 2-by-1 call ratio.
So it sounds so
Essentially,
quiet to me,
we're trying
but
to reflect the upside of 100 shares of stock theoretically, but have a different downside risk profile. As of course, if you buy 100 shares of stock, costs a lot of money typically, and of course you have risk all the way to zero. So what we looked at here in particular in Wells Fargo was to go up to April, just a couple weeks, but we're looking to buy 2 of the 36 calls. The reason that's the call selected is it's the 75 delta or the closest to the 75 delta. You then look to sell 1 of the at-the-money 50 delta call to create a theoretical 100 delta worth of
not bankrupt.
And also, this creates a situation where if you do it for $4,
AMC looks like it wants to break out a bit.
Is effectively exactly where the
just started
stock's
barcoding up here. That's weird.
38. Well, the stock's trading at 38, and so that's the idea. You basically are buying call premium, but not having that time decay working against you. So you have that unlimited upside, but you don't have to have a break
turn up Jenny when she
the
talks.
current share price. So there's always a catch because this is more efficient than buying, of course, just shares of stock. It has all the upsides of shares of stock, and it has defined risks. So what's the catch? Well, the catch is for those first $2, if it goes from 38
new high on
to
SPY there.
36, this would take twice as much risk. So you're paying $4 for this, or taking $400
tomorrow.
in risk.
Well, I'm not streaming.
Well, that's
Closed.
totally realized at 36, where of
Today's
course
last
if you
day.
just bought 100 shares of stock at 38, it went to 36, it would only be $200 in losses. So twice as much risk for that first part, 2 long strikes, but then no risk after that. Unlimited upside potential, much like owning shares of stock. But of course, always differences when you're owning options as opposed to outright stock shares. voting rights aren't going to be a thing. You know, dividend rights aren't going to be a thing. There's an expiration date. So there is things to consider that are key differences. But from a theoretical standpoint, this one is looking to perform like stock to the upside with a very different downside profile.
And Wells is expected to report next Friday, I believe. So we are almost back into the swing of earnings season. The financials will be a very interesting space to watch to kick things off, of course, when we start getting earnings next week. But we'll leave it there for our example trades today. Also important to keep in mind for both trades that multiple legs can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now, coming up next, it's time for FOMO. We are looking at all things Netflix. Lower on the day despite some positive analyst noise. We'll dive more into that Jeffries note coming up next.
Did you guys see that GME had who was it? One of the analysts changed the rating to buy on GME. No, I don't use XLR. No, it's just USB mic. DFVs I think was USB too, wasn't it? Yeah, I just got a Yeti. USB mics have come a long way though. The new ones, like you can get some pretty good sounding USB mics. So you don't even know. I follow that one guy on YouTube. Epox, what's his name? Crazy looking guy. DPS box or whatever. Does all like the mic reviews and all the hardware, basically tech. That was Ace Ventura laugh, okay. He does it in a few movies. The Grinch was one of them, I think. Okay, he did it in Ace Ventura too. It's this one. Like way. Why Bobby's not bullish yet? I don't know. They might still be diluting. See all this volume since it's been plummeting? Very well could still be diluting. Little double top here, maybe on the SPY. Oh, please, please, mister, please. Be a double top. Holding all my shorts through next week. Here we go.
To move it to the downside. But what I found very interesting, Jenny, from a technical standpoint, the stock traded down to around $109 and starting to bounce to the upside here a little bit. That is a critical area of support.
At what point will we know dilution has happened? When they release a filing say they've finished offering all their shares.
That could give you a little bit of confidence that maybe this report won't be as aggressive in the long term when it comes to the stock. I'm sure Airbnb will probably have some form of a comment on this news here. I'm not sure if there's going to be any form of a legal battle as well if they do find find that some of these top bookers are starting to, or hosts are starting to try to poach some of their customers. But it is going to be a very interesting development, to say the least, here. And it's not surprising. We're starting to see a lot of these short reports coming out and hitting a lot of these companies. Obviously, we were just talking about Block a couple of weeks ago as well. So not surprising that we are seeing the reaction in the stock, but hopefully you could see the stock be able to recover. That's what the bulls want to be able to see here in the future.
Okay, Kevin, I was just going to say, I feel bad that we keep talking about these short reports with you, because these are not necessarily the most optimistic on any of these companies. But like you said, not really breaking down altogether here. I know shares are down 4% in reaction, but Airbnb, all things considered, is still up over 30% this year. So not seeing the same nosedive that Block did in reaction to its short report. But I'm curious your thoughts on this whole concept of these,
that red one's a
these large-scale rental companies that do account for about 1% of the properties on Airbnb, but 23% of all of the active listings. To me, that makes perfect sense, right? Because if you're a large entity, of course that you're raking in more listings than, say, just the average person renting out their home. But they see this as a huge problem for Airbnb.
At some point, I'm gonna have Jim Carrey jokes
I
and
was
people are
raised
gonna know
by
what I'm
someone
talking
that works
about.
in hotels, so to me, this space has always been very foreign. But I can't actually see all these people leaving Airbnb and it being that much of a disruption like this report entails.
Yeah, definitely. Obviously, there is also a marketing side of this as well, Jenny. I think you're trying to maybe highlight that a little bit. If you do remove yourself from this platform, you're going to also lose some of that visibility. And I don't know if a lot of these companies want to be able to sacrifice that visibility right now in order to try to break into the space. It is also a very tough space as well, with the competition is really, really difficult at this point in time. Not only are you dealing with other competitors that are just focusing on host and trying to match up individuals with rental properties and things of that nature, but you're also dealing with hotels, as you were kind of just alluding to.
Not a double top, breaking out.
Hilton, Marriott, things of that nature. I mean, it's a very tough space. I'm not sure how much this development is actually going to come to fruition, if you will. The competition is pretty thick. They're going to need to have a lot of capital in order to try to make a substantial
I'm not in the business of buying something that's in the downtrend.
Space, and I would once again kind of say there might be some
maybe if you just have
a
day or two
something that
plan
is
on it
actually
for a bounce.
I'm sure that Airbnb would probably take some
dead cat
form of
bounces all the
legal
time
action in order to try to either dampen it down or try to recover
and find something on the right trend, right path.
Yeah, and some of these horror stories, I will say that I've read hotel incident reports. They're very similar. I'm not saying that they're not serious, but this is something that you just deal with in this hospitality space. When you have people essentially living at your properties for extended periods of time, things are bound to go awry, I just think. So interesting report, but we'll be interested to see how this holds and what the response, naturally, like you said, from Airbnb is. But we'll leave it there.
It's been a
Kevin
downtrend,
Green,
though,
senior markets correspondent for the network. Great insight on Airbnb. Now I'd like to bring back in Alex for FOMO, and we're looking at Netflix. Alex, this is another name we talk about a lot, but for good reason. Netflix has been a really interesting performer this year, and it has really done a good job.
But this isn't really a big mover either, so
its overall business.
Yeah, and this is a name that just got so much hate in this part of the time last year, and we were kind of talking about how there's always this sort of lag effect when it comes to analysts. So at the same time that we were saying, this name just went from $700 to below $200, maybe it's getting overdone. When it goes from 160 up into the 300s, you can start to have that feeling as well. But when it had a $700 price tag, it certainly can go anywhere from here. But the analysts always seem like they're coming back late. And I love that the last little bit of the year, we still capture that massive, massive day in April of last year, where you just saw this stock just absolutely implode, losing about 40% of its value, and it's still basically just clawing back to where it was before that just very dramatic crescendo in that earnings event. But in regards to your comment on how it's approaching business now, I think one of the easiest things to look at is this crackdown on password sharing. When it comes to these internet-based companies, basically all of them, with the exception of Netflix, have an issue where they have inflated user counts. Netflix has the exact opposite problem. It has basically suppressed user counts because basically people just borrow each other's, and so now there's actually incentive or reason for there to be expansion of that. So I think that's going to be a fascinating thing. We all know the stories with the ad rollouts as well. So yeah, Netflix focusing more on how we can make money as opposed to just getting people interested in their service. Another sign of maturation, we've talked about it with names like Tesla. Netflix just the latest of a big company rounding one of those final turns?
You know, okay, the password sharing conversation is one we've had a lot, but it's fascinating to me because I mean, during the peak of Game of Thrones interest, I think my HBO account must have been given out to like 15 people. It's just the world that we live in, frankly. And so those that are getting so mad at it, I'm on both sides of it. I get it, but also it's sort of like, you know, and pay for your own account. People are just so looking to be angry at ways that they'll have to end up paying
Am I
Netflix
focused on just
more.
BBBY? I don't know. I actually don't hold any position BBBY.
Alex, with the success of Netflix, but we did get a note today from Jefferies reiterating its buy rating on
AMC
Netflix,
breaking out
reducing
there.
its price target to $415 a share, down from $425, saying they're bullish heading into earnings, which will be on April 18th, which is coming up. That's in about 2 weeks now. They highlighted that Netflix is enforcing this paid sharing in 4 countries, and the firm is very eager now to hear about consumer behavior. They noted that these first quarter results don't appear contentious, although slightly ahead on paid net adds, but they would likely buy the dip on a conservative second quarter guidance. Wells Fargo also last week did mention that Netflix's recent bullishness on its efforts to crack down on password sharing and convert these freeloading viewers into paid subscribers they see as a good thing. And I swear to God, those were Wells Fargo's words, not my own. But they also did note that really at this point, much has been written about the streamer's introduction of its advertisement-supported tier, and that paid sharing is arguably a much bigger near-term earnings opportunity with about 100 million Netflix viewers using borrowed passwords, including 30 million domestically. 100 million, they estimate.
Wondering why I still care about BBY?
I'm part of that demographic. I get it, but I'm also like, we should
couple
all
reasons.
pay.
You're looking at a YouTube channel.
I understand why Netflix is cracking down.
This YouTube channel.
Yeah, this is one of those things, Jenny, where it's like they're not going to probably get all 100 million to sign up, right? But if they get 10 million of those to sign up, that is a massive win. So it's one of those situations where do they really lose subscribers on a net basis?
I am watching it pretty closely.
Say I collectively with a group of other people decided to split a Netflix account where we're each paying a handful of dollars or a couple dollars a month as opposed to one person paying and then everybody else just logging into it. There's probably situations like that, right? There's a lot of services that cost money on a recurring basis that people share and they split those
kept going
fees.
18%.
But in the end, is there going to be 1 or 2 of those people who are like, I'll just buy it myself? Maybe. So you just kind of go down the list and you start thinking like, this can only really benefit Netflix, in my mind. There's just no situation where the people who are paying for this, for the most part, are really affected by it, and it's the people who aren't paying for it that are. So you start going down there. The ads, of course, haven't really rolled out entirely yet, but this is the king of content now. They're winning awards. They're the most popular streaming service. Streaming is becoming the increasingly most popular way to consume content. They're going to have a really, really nice thing to sell to advertisers in terms of eyeballs on those ads. So you start going through, like, Netflix is in a prime position. It's just going to be threading that needle.
This looks like a nice
a company like Meta did when it slowly changed the Instagram platform. So that, you were disrupted by it, but you still logged on it because it was mostly the same experience. And now, 5-10 years later, it looks nothing like the original platform.
Maybe pick up some shares of
Netflix can do the exact same thing, slow,
maybe not today,
methodical, incremental changes. Today, but sky seems like it's the limit.
I completely agree. And now they've recently discussed the shift into their movie strategy. We're going to be churning out less titles, but focusing more on quality, showing, again, more signs of maturation from this company. So not only will we be seeing, hopefully, better titles from Netflix, we'll be seeing less of them. So I do think when it gets crowded with this, like, subpar content, that can be a negative. But Netflix is transforming, and I think it's been a really cool story to watch it transform. I think, you said, the addressable market here is massive, and it does always crack me up, those people that are the loudest voices that are like, we're quitting, we're leaving, but you weren't paying to begin with, so Netflix doesn't care.
They are.
And who knows, maybe something will come out that they're really interested in, and all of a sudden they sign up for a month. That's the other really big thing with streaming is you don't have to be locked in. It's not like cable where you're locked in for years and years at a time.
Looks like it's rejecting the 50 moving average there on
New Ted Lasso
PTC.
comes out, maybe you sign up for Apple TV Plus, and you cancel when it's done.
I did that.
Yeah, a lot of people do that. And I think it's probably
the lower it gets,
the prudent thing to do unless you
the higher the probability of
consume content, but
that big of
it's still a $150 billion company. It's an expensive company from a valuation standpoint still, because this optimism is built into it. I thought one of the takeaways from that analysts
look
know
at it?
was this concept of buying the dip on weakness. So I set up a strategy that would
5,000
sort of
put
look
it.
to do that, or at least give it some
5,000
cushion to the
would
downside.
be
In the case that this stock does give back some of
13,
these
14.
gains that it's built on
Past the
over the
gap
last
fill.
6 months or so. And so what I looked at here was selling a put vertical below the market, not the most interesting of trades, but possibly an effective one if the stock can hold on to its recent strength. And so in this case, we are going out to May. I know this
merger
will capture
takeover,
an earnings
Icon,
event, so bear that
RC,
in mind.
whatever.
If, that's not
If any of that bid is real,
a
or
particular
actually
trader would be willing
happens,
to stomach, this
and
may
it's
not
not
be a
fake,
strategy
then
they would
yeah, I think we
consider.
could see 5,000%.
But looking at selling the
I don't think
300,
it's real at this point,
295
but
put vertical, if you collect $1, that's
as Bed Bath gets
20% of the
cheaper,
width of the strikes. It's 1/5, so it's a 4
could
to
get
1
more
risk
appealing.
reward ratio.
It is getting more
Typically
appealing.
indicative of a fairly high
AMC.
probability of success, but it means you're risking $400 to make $100. So keep that in mind as well. That risk takes place if the stock were to plunge and fall below 300 and then ultimately be below 295, as that's the max loss territory. 299 is the break even.
Christopher.
Max profit is 100. You keep that if these
Happy
options expire
town.
worthless at expiration. Neither
like
accounts
Happy
for
Town.
transaction fees. But Jenny, I think it's critical
Yeah, it looks
if you're
good.
looking at some sort of strategy like this
buy it right there.
to bear in mind that this stock plunged
Ready
40%
to
last year
rip.
on an earnings event. That risk-defined element of it, I think, is huge, because if you just sold the 300 put, yeah, maybe you could
FAIs.
gain more.
Dude,
but
this
on
thing
that
is not
massive
bad
outlier
at all.
move,
This is
there's
wild.
There's tremendous exposure,
all
and
of
this
the
name is proven that
day
it can
traders
do
and everything
it.
this
So
morning,
what's to
this
say
was
that
probably
it
their
can't
selling
happen
right
again?
here.
I think risk definition is
People want to bring
really
to BBY
something
and
to
just
emphasize
holding.
here.
Yeah, and I think also important to emphasize, the shares are up 15% this year, but like you said, we're still down about 11% even from the yearly highs, which is not even close to the all-time high, spite of the fact that we're up about 110% off of the yearly low. But it's all relative because we've fallen a lot more than we've been able to claw back still in Netflix shares. But that'll do it for our
So that
Fomo
would
segment
be
today.
FT.
Now coming
It
up
didn't
next,
happen.
we will look at Constellation
The people still
Brands.
say it about other
up
stocks.
1%
It might
following its fourth
happen.
quarter report.
Might
We'll
not.
dive more into those numbers on its quarterly financials with
Just because it didn't
Virginia
happen
Young
one
coming
doesn't
up
mean it won't
next.
happen another. But I understand your sting. So we'll meet up after Moaz. Happy down. No one knows why. Why are you so mad, Munir? Fubo? I closed my Fubo. What a bad day, it's 2.7%. Wait, did I close my Fubo? Yeah. I did. I think this thing could still rally, but I didn't have enough time on my calls, maybe. I don't know why I closed it. AMC holding up 25%. SGM 17. Crazy. Wish is moving up a bit. MCB is up 7%. Not gonna give up that easy, are you? This thing could be reversing here, actually. Didn't I close it yesterday? That hammer candle, it's green. Go up 3. Hold top on MU. Oh, SPY. Oh, just on the 5-minute here. Yeah, kind of, but kind of a double top, I'd say, not necessarily a triple, but could just be consolidating, really. I mean, it is consolidating. Could be consolidated before another up move. MACD flip bearish. You are getting an RSI divergence, so yeah, could be a double top. I like that RSI divergence and that bearish MACD. Seeming like a top. Next would be like an engulfing candle or something to confirm. This price range looks like barcoding on SPY, which is weird. A break up here would nullify the short. Breakdown here would confirm it. Have to be pretty low. Really a break of this, but saw it do that and then bounce back up. Robinhood has beautiful UI, simple to use. Makes trading and investing much easier. I'm now red on my NCB short. Get that move on SPY today.
For it. Any final thoughts here before we say goodbye? Obviously, you can see there on the chart a little bit of chop there, but for the most part, kind of survived this earnings announcement sort of unscathed.
I guess this is another bellwether of the economy, right? How many Coronas are people actually buying this time around, right? So we'll just keep looking at this and really find out how consumer behavior is going to impact this stock as well.
Renita, I know that it's like our synthetic Friday or whatever because I am thinking about Corona. Alex and I were saying that a nice ice cold Corona Light with a lime sounds pretty good right about now, and your dress is also reminding me of that. So we will leave it there, but appreciate all of the insight on Constellation Brands with a move higher in reaction to its earnings. Now coming up next, we will look at a name for under 30 that is seeing a completely different reaction to its quarterly update. That is Levi Strauss, with shares down over 14%. We'll dive more into those numbers with Jeff Pierce coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important.
Discussing strategies and example trades on
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. Market holding on to some of those gains that we were talking about at the top of the hour. Right now, S&P's, Jenny, up about 1250, NASDAQ up 82. So there's certainly a little bit of optimism as we kind of close out this week, but we got that jobs data tomorrow. Under 30 time, though, let's talk about Levi's. This is a massive move in the other direction, probably the mover of the show.
Yeah, and I'm frankly shocked by this because we're seeing Levi down over 15% in reaction to its first quarter report, where there were some things to look forward to. I mean, it wasn't necessarily a bloodbath of a report, but based on its price activity today, you'd think so. And actually, when comparing Levi on a chart basis this year, it's underperformed so many of its peers. It's difficult to compare this to other retailers because they do have their own brand that they sell at other stores. They sell on like Amazon or Target. So I was comparing them to like a PVH or like a Ralph Lauren. They've underperformed pretty sizably. So here to tell us more now on their quarterly update and some of those financials, I'd like to welcome in Jeff Pierce. So Jeff, what was so wrong with this report? I did see inventory remaining in pretty much an overhang now despite improvement, but the numbers weren't that bad.
You're right. When you first look at the report, earnings per share beat expectations, revenue beat expectations as well, coming in around $1.69 billion, up actually 6% year over year. They reaffirmed their guidance from their last quarter, which the stock reacted positively to the last quarter's guidance. However, when you dig in a little bit here, as you mentioned, inventories were an issue, but let's start here with net income. Came in at $115 million versus $196 million we saw a year ago. Gross margins also declined 360 basis points, coming in at about 55.8%, really pointing out some of those issues they've seen with cost, including materials, labor costs, freight costs. You mentioned inventories. This has been an issue for retailers across the board. The company said that they managed to reduce inventories, with them only increasing 33% this quarter compared to 58% last quarter. That is certainly an improvement, but investors have really focused on inventories levels over the last few quarters post-pandemic, because obviously these higher inventories mean that these companies have to cut the cost of their items, putting further damage on their margins. And finally, on that, on the full year guidance that they reiterated, $1.30 to $1.40, $6.3 billion to $6.4 billion, both pretty in line with expectations out there in the market. But it does continue to point to a cautious company when it comes to the economic environment and the consumer. And I think that's what investors are reacting to here is a very cautious company and some inventory levels that are concerning.
Couple things I want to get your thoughts on here, Jeff. First off, I think the inventory breakdown you gave is great, but I think it's important to, first think about how do you get in that situation? Well, you get there by thinking people are going to buy more than they did, and so they bought too much stuff. They overestimated demand. So in a time where we've just watched, for example, the Atlanta Fed GDP now go from almost 4% 3 weeks ago at 3.7% or so, it's now down to 1.5%. Rumblings of economic downturn and recession are only picking up momentum here. It's not really boding well for the situation that they found themselves in. But every time we talk Levi's, I say this, and those who have watched this show will know probably what I'm about to say. This stock was founded in 1853. That is like pre-Civil War. It has weathered so many different environments. I know it's not been public all that long, but if you're going to bet on a company, I'm not to say that Levi's won't do poorly or well. I mean, it's just gone through so many different things. It's hard to imagine that it couldn't survive an economic downturn because it has before.
Yeah. And to your point on the inventories, it's worth noting the reason a lot of these companies got into the inventory issue was because during the pandemic, they had so many problems getting inventories. They ended up getting these kind of bulk orders in, and now it's something they're dealing with across the board. But to your point, specific to Levi's, one thing to keep in mind, they have changed their business model a little bit from a marketing focus. They've really changed the way that they do business. They're also kind of switching over to that direct-to-consumer model, which we know has better margins than some of the wholesale model out there. It's a company that's been around for a very long time, to your point. You look back in March of 2020, they're down around $9. They moved up to $30 in 2021. Now they've kind of come back down a little bit, but it's certainly a company to watch watch through this transition. I think these inventory levels are a concern, but to be fair, they're a concern for a lot of companies out there, although there are retailers, you think Lululemon and other names, that have done pretty well in clearing out their inventories without having to break down their sales too much.
So Jeff, you mentioned exactly what I was just going to say, and that's, is there just a broader secular shift where now, right, following the pandemic when everyone was stuck in their homes, not going into the offices, is there just a shift where people are not wearing jeans as much? Because I know that Levi's is a broader apparel company. Frankly, though, they're a jeans company to me, and that is their bread and butter, and are people just favoring more of this athleisure streetwear look now over a more traditional jeans look?
Yeah, certainly the kind of, excitement around athleisure wear that we've seen, the explosion around that, I would imagine has made a real competitive dent against companies like Levi's. And certainly that's an area that has a lot of growth because it's very versatile. You can wear it in the office, you can wear it outside the office, just around the house, comparative to what you see out of Levi's. Even if you think past their jeans and some of their styles, that's an area that's very different than a company like Lulu or what we're seeing out of companies like Nike and even Old Navy brands. So from a competitive standpoint, it is certainly something that the company has to worry about. Now, could they transition into that space in some way? It's certainly a possibility. We've seen a lot of companies do it.
Hey, quick question, Jeff, before we say bye. You mentioned and you sort of alluded to this idea that pre-pandemic inventory levels were kind of held in this just-in-time scenario. Supply chains are going well. You buy it basically right before it heads out the door, so you don't have to store it. Post-pandemic, things were disrupted. It is now more of a just-in-case. Load up on stuff because you don't know when you're going to be able to get it. As we get further and further removed from the pandemic, and as we get kind of further potentially into a tougher time and this stress starts to impact companies, are we going to shift back, or is there still this uneasiness because supply chains just broke down, 3 years ago?
Yeah, well, we have to keep in mind supply chains aren't completely back. So there's certainly going to be companies that are going to be going out there and getting what they can. However, they have eased quite a bit. So these companies are likely going to be a little bit more nimble, a little bit more picky on what they're putting in their inventory so they don't fall in this position again. Now, a company like Levi, obviously their inventories are also going to matter on some of these changes. This direct-to-consumer change is going to be a big part of it versus some of the wholesale numbers that they have right now. So there are going to be some changes. My interpretation is that we are going to see companies being much pickier about their inventories, what they're getting, especially as the consumer behavior changes. And frankly, that's a big question mark for them, is how is the consumer going to be over the next 6 months, year, 2 years, especially with these economic headwinds.
Yeah, Jeff, and I think you made a really good point. That supply chain, as much as we want to say it is back, it is not fully back yet, and that's important to a company like Levi's. But we will leave it there. Appreciate all of your insight, Jeff Pierce, contributor across the network. That also does it for Alex and myself for this shortened trading week. Coming up next, we have the watch list with Nicole Petalides.
Look at that, MSGM 34%. Breaking out there. Between MSGM and GFAI, if I had buying power today, I think I would have done pretty well. That I just held a short through this big rip. I literally could have closed my shorts at the peak and bought in here when I liked it right here. And MSGM. Who doesn't like MSG? Everyone likes MSG. MSG is so good for you. Ripping, it's gonna get halted. 37%. 42%. Oh my goodness. MSG so tasty. Got like 820 for resistance. Little gap fill at 895. Oh, just 8 even really. MSG, so good for me. Go high there, see if they can break that 8. That's gonna be pretty big resistance. $8. 809. That's 46%. Rise, it hasn't halted. 825. That's 50%. %. Holding above 8. 825. $805. 804. 819. Buy, still consolidating up here.
The analyst says that the recent sell-off in Comerica related to the outsized uninsured deposit concentration is unwarranted, and that Raymond James therefore now views the risk as more positively than before. But not all analysts feel this way. JP Morgan is downgrading Comerica to neutral from overweight. The analyst tells investors enter the first quarter earnings season with a fairly limited exposure to regional bank stocks. And Keefe, Bruyette, and Woods actually maintained a market perform on this stock, lowered the price target to $57. But on the whole, Comerica has an average outperform rating and a price target range of between $44 a share and $90 a share.
Yeah, understood. And then we turn our attention away from banks straight over to AMC. That name is higher. Tell us about that.
Much higher. Shares I saw about 10 minutes ago were up around 25% today. And this is after AMC's reverse stock split plans and stock conversion plans are placed on hold. Now, the company says that it's not going to enact this split and planned conversion until a Delaware judge lifts the status quo order that is preventing the company from actually following through on those measures. And so on April 2nd, AMC reached this agreement with the plaintiffs of a shareholder suit to settle the litigation and then to request, and they request the status quo order be lifted. The plaintiffs then filed an unopposed motion on Monday to be able to lift that order, but the judge denied it on yesterday. And going forward, AMC says that it's not going to make the litigation settlement payment that it originally agreed to, and that the company will continue to evaluate the situation. So this is a holding pattern, but today investors really like this news for some reason, and they're buying.
MSG is so good for you.
Good to see you.
873
Appreciate
it hit.
Thank you. Now let's take a look at the bigger picture. Eric Cerner's with us, Chief Investment Officer at Apollon Wealth Management. So glad you're here. We just
AMC
talked
is
about
so
the market
confusing,
turning
like
around, and
BBY.
we've seen sectors like energy doing well.
I think I should avoid
Healthcare
confusing
has done well
stocks.
this week. Look, tech is taking a turn coming off the lows, but you're still feeling a little apprehensive.
MCOM's
right?
even getting a pump from it.
Absolutely.
From
Well,
the
first of all,
MSG
thanks for
move,
having
I
me
think.
back on the show. But I do think that there's plenty of still downside risks in the market right now. As we've seen over the past few months, we've seen many signs of a cooling economy, 11 straight months of the leading economic indicators being negative, an inverted yield curve. And now I think what we're going to go into next is an earnings recession. I mean, typically during the sequence, you see a bear market, then an earnings recession, then economic recession. And in the fourth quarter, we saw earnings down nearly 5% across the board. And now expectations for this quarter are earnings going to be down nearly 7%. And this is all part, really no surprise. This is what the Fed's been trying to do over the past year: raise rates, the cool economy, and bring inflation down. And so as earnings come down, that's going to put some more pressure on the stock valuation.
GM came back to be up there, 775.
I mean, what are you thinking about when you say that for the S&P 500?
Yeah. I mean, obviously we've been in that 3,800 to 4,200 range, and right now we're at the top of that range because the market really had a solid first quarter. But I think we're going to fall back down to that lower range, and we'll see how the earnings come out. And I think there's a better chances of us going through the 3,800 than above the 4,200 in the coming months.
Right. At this point now, what do you tell? You think you're leaning more towards fixed income investments more than equity investments, right?
Yeah, I think there's just so much uncertainty in the equity markets right now because we know the Fed is going to be restrictive until we get inflation back under control. We don't think inflation is going to get to the target rate by the end of this year. So with all that uncertainty, the fixed income markets, it's a once-in-a-lifetime opportunity for many of us because we haven't seen yields like this in 20 years. So instead of taking that risk in the equity markets, I mean, you have 6-month treasuries paying 4.7%.
Right.
You have investment-grade bond options yielding nearly 6%, which is actually really close to the average stock return on an annual basis. So I do, whether both on equity and the fixed income side, I do think a recession is coming. So it's really important to lean more into quality, both on equities, so long-term quality earnings, and on the fixed income side, look for those government and investment-grade bond options because I do think we are heading towards a recession in the coming months.
You talked about net profit margins and the numbers that we've been seeing and decreasing, and that earnings season overall on the last round, in your opinion, was subpar. And so with that, recession, I guess, more likely. So, and you said earnings season now. Tell me about, like, when you look at these specific companies, what are you going to be looking for?
Really just their guidance going out and how we've seen, like you said, 6 straight quarters of net profit margins going down, which is as expected with the historic inflation levels. But the forward guidance should be interesting because when you look at the last 10 recessions, earnings per share dropped nearly 29%.
Yeah.
And if you exclude the two biggest recessions between the GFC and the tech bubble, they dropped 18%. So from what we could see right now, we do expect this recession, if it does happen, to be a mild one. But I do think we're going to see earnings per share continue to drop this quarter as well as the second quarter and probably drop more than 10%. So that forward guidance
testing the top of this
should be
little
very
channel.
interesting and should tell us what direction the equity markets may go as we go further into the year.
How concerned are you about a credit crunch after a banking crisis?
Yeah, I think that's, obviously, I'm not as concerned about contagion because I think what happened with Silicon Valley was very unique as far as their portfolio duration management. Credit Suisse has had problems for years. So I'm not so concerned about a banking contagion, but we are going to see tighter lending standards based upon that.
We're already seeing that.
Exactly, and it's just going to get tighter.
Understand. People are trying to get loans for businesses that would have been easy, now it's been less easy. Mortgages, for example, we had on Dolly and Jenny Lenz, they worked very closely with First Republic, where they would easily secure mortgages for folks that probably were deserving and all that, and now they said it's just different. It's just not the same, and that stalls things, doesn't it?
It's absolutely, and what was kept, one of the things that's kept this labor market so strong is just the leisure and hospitality side, the services sector regaining and those jobs from the pandemic. But a lot of those small companies depend on these smaller and regional banks for their lending purposes. Yeah. So if there's going to be tighter lending standards,
GM
and that's going to hurt some of these
still.
more service-oriented companies, then that's really going to affect our labor market, and it's going to push up the unemployment rate, and another reason why I think we're heading towards a recession.
And the actionable advice that you have is, you said you're very bullish on
Wish still 6%.
income
SPY testing the high there.
Describe
it's
or
going
advise
for
to
it.
folks when you say
Going
that?
for it.
Well, I like the shorter term options right now between the treasuries and investment grade bond options, because I think once we get inflation back under control and get it closer to the Fed target, then we're going to be set up for a
If it breaks to the upside here, we're probably going to get an engulfing candle today.
So I think for now,
even if it doesn't, it probably will, but
put it into the fixed
there's still a possibility we
markets,
come back down.
Hopefully, as we get closer
and
to that
don't get engulfing
Fed 2%
today.
inflation rate,
407,
that can allow the
86.
Fed start cutting rates and hopefully set up the
Move back to
economy
here.
and the stock
happen
market for a
today.
really strong recovery, either at the end of this year or going into 2024.
And then, U.S. stocks could really falter. There's a lot of concern about the debt ceiling.
Yes.
And, as this lingers on and drags on, does that affect stocks, or
Oh, absolutely.
what do you think? I mean, because I know there's a lot of political theater, and it usually gets settled. But what does it mean for investors? What do they need to watch?
Yeah, I expect the government, I have high expectations like everyone else that it's not going to get to the point where the U.S. government is going to default on any obligations. But the closer we get to that deadline, it's just going to create more volatility in the markets. And we already have
will it weigh
enough.
on stocks, do you think?
Oh, absolutely. I think it'll affect every asset class out there. So, hopefully, like you said, a lot of political theater, and hopefully we settle this closer or sooner rather than later, because if we come close to that deadline, we have enough volatility and turmoil in the market right now. We don't need to put that on top of it.
Joe Bruce-Willis was on with us this morning at RSM, the economist there, and he was talking about the new metrics that they're using for these jobs reports. He's redoing his forecast for tomorrow. He has it under 200,000 jobs to be added for tomorrow. Any thoughts on jobs and what the Fed does next?
Yeah, I think, at this point, really the Fed, all signs and pointing towards a recession, and the last indicator to fall is the labor market, and we're starting to see those cracks now. So I really don't think the Fed really needs to do much more other than keep rates at this level. However, they want to make sure their number one priority is to kill inflation, and even if that brings financial pain to many.
There were earnings
there
today,
may be another 25
Banker.
basis point hike, maybe two. It was interesting when we saw the peak rate at the last Fed meeting, where they said that the median, they were saying, was the peak was going to be, or terminal rate was going to be 5.1.
They've been talking about it on this channel all
but
day.
7 out of the 18 officials had predictions above that. So there's a lot of disagreement in the Fed right now as far as how high rates need to go. But from what we're seeing right now, we have every indicator pointing towards a recession. And even with that labor market coming in tomorrow, it's interesting because if it comes in too hot, the market
STZ and
may
Levi
react
pre-market.
negatively next week, and the Fed will do more work. If it comes in too cold, the markets may react negatively, thinking we're going to go
is after hours.
Another reason we're going to go into a recession. So very interesting times, a lot of data to consume, but we'll get through it.
Thank you so much. Good to see
my
you.
earnings?
Eric Sterner of Apollo.
I gave away a lot of earnings holding it short through this.
Later this hour,
I haven't realized any earnings.
We'll find out why
I haven't realized any
methane-powered
gains today.
tractors could be a big growth item for CNH Industrial as the company.
But yeah, my cash could put on AMC worked. I'm actually trying to get out of it now. I don't want to mess around with AMC. I'm scared. How about View? View. How about it? Oh yeah, it's getting right to that support. Like to see some signs of reversal, but it is at a nice support. Need a couple more indicators. Be bullish on it. What is this thing? Thing that doesn't probably make any money. No, loses 87 million a quarter. I could lose 87 million a quarter. I could do that. BFRG Burf. Oh, is that Bullfrog one? Yes. I don't even know how you can see a breakout with this choppy penny stock chart. Yeah, if it breaks that 5 level, it'd be good for a gap fill. What, up to a 407? Or sorry, 5.7. SPY new high. Broke out of that range. 409.85 is next move up, I see. It's up 0.4%. I hope the data crashes the market tomorrow. Been trading for a long time. That's good. Take a step back, reassess. I've kind of been doing that. I'm still trading some, but I slowed way down the last, I don't know, bit. I find it's good to stop and kind of get out and then spend money. I like don't ever spend money. It's a good thing. But I'm just on the computer trading. It's like you lose the value of money. Which is good because you don't want to be emotionally attached for trading, but really bad because you just lose money and it doesn't phase you and you just keep going. I don't know. It's weird, but having lost the value of money is kind of a scary place to be. Look at that wick. False break. Won't come back. Depends on what come back means.
D20. The warehouse chain reported net sales of $21.7 billion in March and a 1.1% decline in comp sales. E-commerce numbers slid 12.7%. But analysts from Telsey Advisory and Oppenheimer maintain outperforms on Costco. Wells Fargo
big crash, yeah.
And we're going to be watching.
Yeah, I think so. I think we're still due for a crash. We've been in a bear market for over a year and never really saw a crash. Bad weeks, but
to $47 from $52.
no capitulation yet. Every time it's just been bought up. Lunch protection team. The banks started to, but then the Fed pumped in money to save those. So
rising inventory levels did create some concern for
investors. Propped market for potentially 40 years or more since we left the gold standard. Thanks, Nixon.
Then there's Airbnb, the latest company to be subject to a short report.
What's up, MT?
The Bear Cave report alleges a group of managed properties could gear up to directly compete against Airbnb. Short report saying that these hosts are listing properties cheaper than Airbnb, representing some of its best and largest hosts. So we are watching that closely. And in the meantime, here's a look at Bitcoin. 28,220, down 0.5%. All right, let's welcome in our next guest. Christopher Bartow is standing by, investment analyst at Fort Pitt Capital Group. Thanks for being with us. So you're looking at different sectors. Just start with the big picture, because I know you're going to be picking, but so much of it has to do with your thoughts and how the market is acting and why.
Of course. Well, thank you for having me. So our current outlook on the broader market, it's pretty sanguine. There are opportunities for investors within specific sectors. There's been a lot of news lately in the market, anywhere from Silicon Valley Bank to inflation to oil prices. And we believe that if investors look through the news and the headlines, you can find great businesses at great prices while focusing on your core fundamentals. And as we've seen in the first quarter, investors seem to largely look past these headlines right now and seem to be discounting some sort of rate cut in the future from the Fed. So at the end of the day, we think that well-capitalized businesses should take advantage of the opportunities given in the market right now, whether it is acquiring smaller businesses, competitors, buying back shares, or raising their dividend for their shareholders.
Right, understood. So at this point now, you have to really figure out what might work in an environment that could be volatile, could be recession-bound, consumers that are feeling somewhat strapped. So let's break this down a little bit. Let's talk about the ones that you do like. Which ones do you like and why?
Certainly. So there are 3 sectors right now that we currently really like. The first one is healthcare. Healthcare has historically been a defensive place to hide in amidst market volatility, while capturing stable cash flow and dividend growth from this sector. Healthcare companies are a necessity and relatively recession-proof as people do need drugs and their healthcare. There's also been a lot of M&A consolidation that's been happening in here, which should bolster pharma pipelines and add to current market share of those businesses as they scoop up competitors and have better pricing power. A few companies that we like here are Bristol Myers as well as Novartis. Both have a very strong pipeline of drugs with durable cash flow to pursue acquisitions and bolster their market share in their respective markets. A second sector that we like are industrials and defense. Between expanding defense budgets and improving supply chains, defense is an attractive sector for us. The war in Ukraine, unfortunately, is a catalyst as we see defense equipment that we send over there to help them, as well as companies and governments restocking their piles. We also see an improvement in air traffic, as well as we return to vacationing, and travel continues to be a catalyst for repair and maintenance on planes. And we are also seeing continued airplane orders as well. Between new contracts being awarded to these companies, stockpiles being refilled, and attractive valuations, we believe this is a sector definitely worth monitoring.
Okay, so let's just touch on energy. Energy has been one area that has been jumping the last couple of weeks, so much so that it's above $80 a barrel now at this point with a surprise cut from OPEC plus cartel.
Yes.
Is this something that you would like? Do you still like some energy stocks, or do you think it's overdone? Or they are dividend payers. There are folks who think energy oil is going to 100.
Yeah, so we definitely like the energy sector a lot here. The most recent news of OPEC cutting production, in our view, we do think it bolsters the price of oil. Demand for oil while cutting the supply should bolster the cash flow of the energy sector and should give shareholder returns in the form of buybacks and dividends, which, with bonds looking attractive right now and the current yields out there, this gives investors in equities a place to park their capital while looking for risk to the upside. Energy did get beat up a lot in March. It was a pretty unfavorable sector to invest in, and we believe that the pullback represents an opportunity to add to high-quality energy names such as Chevron, Devon Energy, as well as Kinder Morgan.
All right, is there anything else, Christopher? I mean, I don't want to press you too hard. Were there certain names in energy that you liked that you could mention? I know you mentioned in the healthcare, you mentioned Bristol Myers and Novartis. For the industrial and defense equipment and energy, were there any other names that you like that investors can take a look at?
Yeah, so in energy, we like Chevron, Devon Energy, as well as Kinder Morgan. And then in industrials and defense, we like John Deere, we like Lockheed Martin, and Raytheon.
Yeah. What are you thinking about the Fed and the jobs report? And there's been a lot of talk about this. Are you worried overall, or not so much?
So at the end of the day, the Fed is trying to kill inflation by keeping a more restrictive monetary policy. And we do think that they're doing a pretty good job at that. We think that they will probably hike one more time this year. And we do think that we will see a higher for longer type of stance here as they monitor the data, inflation, jobs, housing reports coming in. We do think that housing will roll over very nicely in the second half of this year into next year. And we think we will see a drop off in inflation.
Yeah. Thanks so much. Christopher Bartow, investment analyst at Fort Pitt Capital Group. Thank you. Coming up next, the future of farming. Methane-powered tractors, just one of the products from CNH Industrial that we want to talk about. We're going to talk with the Chief Technology Officer next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Did it buy Lulu? It was below 300. It'll come down. It'll come down with everything else. It's all gonna crash. AMC kind of bounced off that 50 moving average. Right at 7. Consumers that are strapping can be dangerous. Well, yeah, that was earnings rip. Can't predict that. Purely guesses. Hey, Steve aside. BFAI finally touching VWAP. Got some profit taking coming in. Oh, SPY. SPY broke that level, still climbing up.
The waste on their farm, they can turn that into methane, and they can self-fuel their vehicles, self-fuel the farm energy required to run the home or the operations, and be more independent in controlling the future of their input costs on the farm today.
When we think about the industry overall, right, there's agriculture, there's construction. Where are you seeing the most demand?
Certainly in the agricultural space, you see a huge demand. You know, these vehicles are running typically 10, 12, 14-hour days. The fuel distribution network, you know, adds costs. And certainly within the economy today, you see the rising fuel costs for farmers that have very thin margins that they're managing today. And so the demand to find alternative sources of fuel, combined with the regulatory pressures to reduce our CO2 emissions,
Look how far SPY is from VWAP. Might get a big flush before today.
Is really creating demand there.
Or
Certainly
rip, or
construction
both.
has opportunity.
It's broken
We
out
also
of this,
see
so I feel like
opportunity for
might-
methane
could come up more
outside
before
in
we
powering
drop, but
manufacturing, powering city
I'm not bullish into the
municipalities,
close.
schools, etc. And so we think that this ability for the farmer to create their own energy and be able to sell their energy that's in excess back
This is another
to
RSI
the
divergence.
community will help really drive down costs and change the fuel market in the future for these farmers.
With sustainability being such a focus now, not only for your company, but also for so many companies around our globe, how quickly does all of this sort of take hold? I mean, I'm sure every farmer would love new tractors or do this. I mean, how quickly does the turnover happen?
It's a great question, and I think, you know, it's definitely going to go at the pace of what the farmer can actually invest to reduce their costs of input, as well as the life cycle of their farm equipment. You know, this is commercially available today. As we roll it out across the UK and further expanding into Europe, you know, definitely going to see 30% reduction in those running costs, which is a huge incentive for these farmers to move faster. You know, the average turnover of a cycle of a product is anywhere between 3 and 5 years. And so I think we're going to see this cycle pick up over the coming years and continue to accelerate from there.
And when you talk about your world-class equipment, what really sets you apart from some of the other names that we know very, very well?
You know, as you know, we've got great iron, and we're really marrying it with that great technology and our methane capability. We're the only OEM manufacturer in agricultural today offering compressed natural gas and liquid natural gas, being able to take that off the farm. You know, the benefit, and you know, on top of the fuel, is the output from that fuel is also fertilizer. And so you immediately reduce the fertilizer costs for the farmers as well. And we believe by taking this farm waste, the waste from the farm animals to produce fuel on the farm, is only going to make this farmer more sustainable, as well as more productive and ultimately more profitable. And that, you know, that first to market, the innovation we're doing hand in hand with our farmers is really what's setting us apart
high on
in
the
the
spy
marketplace.
there.
Yeah. As we talk about moving the world forward and the future of farming, and these tractors, at the same time I think about electrification of vehicles and things, are you seeing and doing that as well?
Absolutely. And, you know, back in December, we launched our first full electric light utility vehicle we call the T4. That product is on path to be production ready early next year. And it really is a utility-based tractor that's in a similar space to where we see dairy farmers and specialty farmers, where there's a lot of pressure to reduce the emissions on those farms, and where their customers want to know the sustainable chain of how their products are being developed. But, you know, within electrification, you have limitations in what electrification can do off highway today, where, you know, 4 to 6 hour run rate works for some farmers, but those farmers that need to have 6 to 10 or 10 to 18 in harvesting, you know, we've got a path where it can be electrification, hybrid, and alternative fuels like methane. The larger the tractor, getting into that combine space or sprayer space, very difficult to have a full electric vehicle today, and we have to use products like methane to reduce emissions and drive productivity and cost down.
Do you already have orders or interest? Because so often, even before production happens on whatever,
I don't think that would be very practical.
The tractors at first.
You basically have to build huge
these other T4 vehicles.
roofs and domes airtight around the cows
Or people putting money
for their
down
graze.
and saying, "Hey, I definitely want to get that when you have the production ready"?
So certainly on the methane space, we've got 12,000
Well, I suppose if they're not free range.
in the UK that have 75 cows or more that
Probably
can
not
immediately
worth
take
it, though.
advantage of the Benjamin methane T6 tractor solution. And the interest there is very, very high. We've got
We're
our
doing it
first
with,
dealer
like,
signed up, helping us
landfills?
expand the capacity and the reach of the T6. On the
Little
T4,
easier
almost
infrastructure,
every
I think,
single
just
day I have a
because it
farmer
sits there.
reaching out to me who's got an interest in bringing that product to their farm. Today, we're really in that final stage of product validation, and we're having to say to these farmers, you know, it's on its way, it's about there, but keep your interest high. And also, we're engaging them in helping us test. So we're seeing
They do
tremendous
fart a
interest
lot.
in this space, enabling the farmer to drive sustainability to meet their own customer needs, as well as manage
All right, Ace, let's
productivity
do it. We'll
and
start at
reduce their
Mexico.
input costs. We're also seeing, you know, in around the world,
Cow
great
fart
incentives
harvesting.
being offered to these farmers to start to turn their fleets over.
Cheaper
And so
energy
they also
for
want
all.
to take advantage of these incentives, just
Your
like
energy's
we've
already
seen
cheap there,
in
never mind.
electric cars here in the United States.
We'll export
to
it
be able
to
to turn their
US.
fleet and move to this more sustainable future for us.
Straight to the tractor.
Yeah, I think that first step is having that first dealer signed up for the T6 tractor, and when you have that, that's how it begins, right? And now you have people already interested in the T4 vehicle, but you'll get that out. Mark, it's great to chat with you. Come back soon and give us some updates. Mark Kermish, thank you. Chief Technology Officer, CNH Industrial. Thanks for being on the show. All right, still ahead in the second half hour. We're going to take a look at REITs, find out which sector
The grass
will
they
be
eat
an
is just fine.
attractive spot.
Gives them plenty
And
of
we'll have a
gas.
break in 2023. Let's take a look.
I'll invest in the beans. BBBY. Look at you. Pretty flat today. Oh, just got filled. That's right. BBBY calls. Wait, no, is that AMC? Oh, never mind. Just close my AMC. Tiny profit. I kind of looked out on that one. Literally sold calls AMC here for 4.5. Dumped next day. And then 2 days later, back up to 5. Yeah, so data farm there. And I just got out. Got my capital back. Now I've got 7,500 to put into BBY, which will buy me more shares than I had when I sold. And when I sold, I was taking like a 15 grand loss, I think.
I was reading from this report in France, actually, Alphabet is in talks to reduce its headcount through voluntary departures, planning to offer severance packages, hoping to convince its workers now to leave peacefully. So we've seen this strategy now with other names like Amazon, but right now Alphabet is under fire a little bit for it because they're having employees that don't want to leave. They want to get the right benefit packages to then walk away from the company. I think that makes sense with a company as large as Alphabet or even Amazon that are laying off off 6 to 10% of their overall workforce, you're going to see this pushback naturally here. And I think it does humanize the whole experience. We talk about layoffs so frequently, Nicole. I think it is important to remember that these are people with real lives, real jobs that are being let go. So I thought that was an interesting report we got today from Bloomberg. Alphabet, though, shares are up over 24% this year, down about 20% from their yearly high, but now up whopping 31% from their low and making a nice move higher today.
Yeah, without a doubt, we saw tech so heavily leading the pack when it came to layoffs last year, and just in the first couple of months of this year doing the very same thing. So that story continues. Tech and financials really are where we're seeing the most layoffs. Jenny Horn, good to see you. Thank you for all of that. Time to turn our attention over to REITs, real estate investment trusts, where we've seen a lot of pressure on this group. You think about commercial real estate. Within REITs, there's so many property sectors. So that's what we want to talk about. Rich Anderson's with us, Managing Director, Senior Equity Research Analyst at SMBC Nikko Securities America. Thank you for being with us. I mean, there's no doubt that REITs were always a safe haven. People love to go to REITs when they paid dividends, but it hasn't been so because there's been a lot of concern about REITs overall. Is that correct? And what do you think is the trend?
I'm in engulfing candle there.
Yes, of
If it
course
actually
it's
comes
correct.
down.
There's a correct observation. There's a lot of tentacles to what's going on around us, whether it's the layoffs that you just mentioned, property value question marks, whether they're coming down to a degree, cost of capital is up for the REITs, regional banks, under the microscope with SVB and so on. So, in the present tense, it's a fair statement that there are some, areas of concern for commercial real estate and the REIT sector specifically. But these are some of the best capitalized real estate companies in the world, great balance sheets, well-covered dividends and all that. So the day may come where the REITs will really be able to act in this environment and be opportunistic. But perhaps that day is not quite yet. And we have to first clear these hurdles that we're seeing today to start having that conversation.
And, just like picking stocks, I mean, I think that's part of it, too. Barry Sternlicht was out recently. He was talking about New York City real estate. And he was saying, look, B and C companies, buildings on side streets, I'm not sure that I would get in there and buy those up. But then he talked about SL Green's One Vanderbilt, which is fully leased and thriving. So it's really trying to find the A-listers within the group. And I know that there are so many headwinds that you described some of those just now. But there are certain areas that seem to be stronger within real estate than others. Explain that.
Yeah, so, I'm a REIT analyst, but I really cover 15 different industries that happen to share the same tax code. So, what happens to the multifamily sector is completely different than what happens to the mall sector and so on down the road. So we think to mention multifamily, that's an area to really, to keep in mind here. The dislocation of the single family housing market, you would think renting apartments would be, a priority item for people on the consumer side to say, listen, I need a roof over my head regardless of what happens. And so multifamily kind of checks off several boxes for us as a defensive play in this space. And the same can be said about a sector called like senior housing, which is perhaps a cousin to multifamily, but caring for the elderly folks of the U.S. population. Another area where, there just seems to be a basic need.
Yeah, it makes perfect sense, right? So you're going to see areas that they are recession-proof. Senior housing is senior housing. It doesn't matter if you have a good or bad recession. These things happen, right? You talk about multifamily, industrial, medical offices, right? Versus maybe I used SL Green, but the truth is office space has been harder to fill because people are not back to work 5 days a week, maybe not commuting to cities in the same way. So let's go through some of these names. I mean, you have in healthcare, life science, medical offices, you had different names. Gaming, you had a name here too. Go through some of those names. Yeah,
so in gaming, you'd be surprised how resilient gambling is in the midst of a recession. It chugged right through the pandemic and continues to do extremely well as we sit here today. The name we like there, we like. There's two that really own the space: Vici, VICI, and GLPI. That's Gaming Leisure Properties We mentioned Vici here, which is a large cap name and has done a really great job consolidating in the industry, and really great growth profile ahead of them. But the underlying theme there is the basic strength of people treating gambling in the gambling community like bread and water. And so gaming kind of checks off a lot of boxes. You mentioned medical office, company we cover that just got through a merger, Healthcare Realty, tickers HR. The medical office property is part and parcel to how these tenants, namely the hospitals and doctors, do their business. So you don't have a situation like you do in conventional office where, well, maybe I'll go in the office, maybe I won't. A doctor has to be in the doctor's office, and you as a patient must go to the doctor's office, to a large degree. So that if we're going to play office, we're going to play the office sector where there's niche applications, where there's a basic need for people to be there to use their space, and that's what creates value. The conventional office has a little bit more of a headwind story ahead of it, even the SL Green and some of their high quality properties.
Right, and you mentioned, I know Alexandria Real Estate came up. You were talking about that for life science office, the HR, which was the healthcare REIT, TRNO in the industrial, that's Terrano Realty. That was another name that you had on there. Any final thoughts on these groups here? Because you did mention the malls, and it sounded like, I mean, I don't want to, extrapolate. You tell me about them.
Well, so my concern about the office space is it's the modern era version of the malls 10 or 15 years ago. 10 or 15 years ago, we started to question whether or not we'll need a mall with e-commerce, certainly not Class B malls, the very high end perhaps. Now we're looking at office and saying, do we need office? Maybe we need the very high end like One Vanderbilt, but do we need the suburban Class B, 80s vintage office today? That's the question mark. And so, you mentioned Alexandria. That's an office REIT that specializes in life science. Life science is a necessity item, drug research. And so that's another office application that works. But you really got to dig into the finer print with office to really make a call here in this environment, in my opinion.
Great to chat with you, Rich. I enjoy this conversation very much. And as you said, you cover so many sectors, but they all crisscross in the world of REITs. Thank you, Rich Anderson.
So it makes my life interesting.
Yeah, for sure. Equity research analyst at SMBC Nikko Securities America. Coming up, let's talk about Walmart. So what did we learn from the latest Investor Day? We'll get the expert takeaways next.
Well, the day's not over, Steve aside. We've got over an hour left, hour and 10 minutes. So, but yeah. Just continue to chop, kind of consolidate. Similar to here still. So tomorrow should kind of decide the direction for next week, I would imagine. PA though, yeah, we're still at a resistance. Did get engulfing yesterday. However, today we're getting a bullish engulfing. So after today, more likely consolidate to go up or down is 50-50. So yeah, but I was also, I mean, with yesterday being kind of red, but not that red, like big bounce end of day, showed that they're not ready to sell off into the weekend. Yep, just more chop. And then when we do get a move, it's after so much chop and such a big range that it makes, like here. By the time it actually confirms the direction, it's just like 1 or 2 days. There's a direction, and then huge chop. Like, this is crazy. This is crazy. All this in here. It really just encourages day trading and scalping. Expect to rip every day except Wednesday. One way to trade. close down here, 408.32, then we wouldn't get that engulfing candle, so possible we still don't. No, 407. The 407 or 48? Oh, it's 407. Because yesterday's candle was so small, that candle body. 407.86. So yeah, down below this resistance. Yikes. That'd be a pretty big sell-off in today. We'll see. Might get it. Yeah, futures will stay open though. Have a look at these April 5-cent calls. Actually, cash secured puts. Let's see how these things have moved. Basically just gone up, so trying to trade these just hasn't made any sense unless you've been buying them. I was thinking intraday you could flip them, but not really. Should have bought these things, dude. What in the world? Went from 4 cents to 24 cents. Ah, we stuck again. Why didn't I buy? Why didn't I make money on the downside? What's wrong with me? Seriously. Like.
So that should really help to drive labor efficiencies and
I'm trying to dip by calls and quick get out of them. Ahead. The fact that I've been breaking even on these is incredible. On a long position on BBY doing this.
I mean, we really got that from Zuckerberg. But let's just stay with you for 1 second, Corey. I mean, you do have a buy rating, right? And your target is 175. Are you sticking with that?
Absolutely, and I think that the key here is that if you think about the earnings power for this business, over the last 10 years, the company's averaged a 5% operating margin. Last year, the operating margin was 4% because it was a pretty anomalous year. So as we think about the trajectory for earnings here, I think that the trajectory is up. If there's anything that I can glean from my time with management over the last 2 days, it's that the trajectory is in fact up, not down, which I think should bode well for the stock.
Right, understood. Scott, as you talk about the commitment and getting that return on invested capital, that's something that stood out to you. Do you think Walmart is still a leader in its group? How do you have it rated in the competitive landscape?
Yeah, I mean, Walmart's our top pick for 2023. I think we have confidence on that. I think we gained a lot of confidence on the years after 2023. This is an equity that can work for a number of years. R5 is both a research and a consulting firm, so we spend a tremendous amount of time in stores. And we talk about efficiencies, the distribution, and that's great. But if you're not running a good store, you got a problem. And I think the most notable thing that we've seen, we've pulled a lot from our consulting division for this, but we've seen just a tremendous improvement in store execution. So you're combining a bunch of things here, whether it be automation, but also in-store execution, store standards, better produce, better merchandising. All those things are coming together. And we think this is Walmart's one of the best buys now for like the next 3 to 5 years. It was impressive down there. I agree with what was said before. I think the management team is focused. I think Doug McMillon, who's been there a decade, CEO, is likely now thinking about a little bit about his legacy. And so all the things seem to be lining up for investors that want to be in Walmart, and we recommend it strongly.
Yeah, did you have a price? I understand it's your top pick, and you said 3 to 5 years. It's a best pick, best buy right now. Did you have a price target? Did I miss that?
There's a SPY coming down.
Yeah, we're creeping up towards it right now, but I think as we look at the equity and we're reviewing our numbers coming off the analyst day, but I think that I agree with what Corey said, is that there's a lot of upside here if you can get the company to perform as they're trying to get some margins up, get some market share wins, get the sales growth. So I'd say that's like a more near-term thought, the mid 150s. I think there's a lot more upside from there.
Corey, I was going to ask you about this whole international well-positioned focus, but I only have about 20 seconds left. Just final quick thought, Corey.
Well, I think the reality is that Walmart's gaining share not only in the
Look at
US,
this inverse beta on a
but
little bit
also
on BBY.
internationally. And so you're starting to see that manifest not only in numbers, but also in market share data that we track. And as the company's become really focused in driving specific growth in regions that it's really chosen that it wants to blossom in, I think that like for example, exiting the UK is one thing that Walmart's done strategically over the last several years to really help to bolster profitability of that division. And now they've outlined a plan to really scale that business over time.
Corey Tarlow, Jeffries, Scott Mushkin of R5 Capital, thank you both. That's going to do it for us here on the watch list. I'm Nicole Petalides. Market and Close is next.
See, it seems like this inverse beta shows up every now and then. Can anyone tell me why I didn't buy 50-cent puts for April instead of sell them? Or instead of buying calls? For the last 5 trading days, 6 trading days? On BBY? From here to here? Anyone help me? These went from 4 cents to 24 cents. Turned $25 into $625. Doing that right? Yeah. Because I don't follow my own advice. I thought it was coming down. I didn't advise to come down, but yeah. Why? What? What? Oh. Right? Heck. Oh, it could have been such a nice, easy short. The hold would have been literally the easiest short, just everyday grind down. I do, I have a list. And one of them is listen to myself. But I don't listen to myself by reading the list. I've showed it to you guys before. It's patience. Listen to yourself. Be decisive. Kill losers quickly. False breakouts through resistance and support are common. Wait for it to confirm the direction before playing the breakout. Trade the trend. Trade the range. Zoom out before taking a trade. Don't hold through announcements. i.e. tomorrow. I like to write the rules down so I can break them all. Close futures for day when plus 1,000. And you know this, it says read the list. I've got sticky notes. None of them say read the list. I should maybe make one. Read the list. I try to read it every day before trading. I've done it some days, but I have to actually follow it. No, the short on BY, that wasn't one where it's listening to myself, more or less. I mean, I guess I didn't want to short it because the options just seemed so expensive, which they were. The IV was crazy. I know I have no way it's going to drop that much. The share offering, like I thought, okay, it's going to keep coming down, but it lost over 50% of its values from when I sold, which is insane. So, but yeah, even so, with this IV at 367%, these options went from $4 to $24. That is a huge gain. I figured you were. Is like little reminders for yourself. Such a good idea. Absolutely. No, that's why I agree. Like beginner traders, it's not like beginner's luck. It's because they're not overthinking stuff. They don't have any past experiences to sway their emotions or their decisions one way or the other. Like bag holding would cause you to then sell winners too quickly, or if you held past peaks and hold till they lose, then you're gonna sell winners too quickly, or if you sell too early, then you're gonna hold too long. So yeah, you don't have any of this past emotional experiences that you've been through, so you just kind of trade on just basic instinct, and it works. So yeah, not overthinking stuff. That's where, let's see, where is that on my notes? That is I don't necessarily have that specifically, but that's kind of the listen to yourself. Like me all in on Ulta. Yeah. Followed by anyone who puts at the bottom of the chain. No, this whole listen to yourself and the BY thing this isn't one where I'm beating myself up like I didn't listen to myself. That's a little different. Closing down here on my short, that maybe could have been a little bit. The BY thing is just like, it's more like I didn't even think of it. Like, make money both ways. Why didn't I think of it? Like, okay, broke that support that I didn't want it to break. So if I'm not going to hold longs, that means I think it's going to go down. So if I think it's going to go down, I should make money on it going down. Like, I don't want to short the shares. I didn't even think I should just buy puts. It's like, I don't know. Given, of course, again, I didn't know it was going to make this big of a move, but each day it's continued to look bearish. And even today, like, it still looks bearish, but I do think it's getting towards the bottom. So that's why today I'm not necessarily going to buy puts on it. But that said, this is another bear flag, just like here, just like here. I don't know, maybe I should buy those. Just like, It could be the same. Rich Man of Babylon? What does he say about that? Listen to yourself. I've listened to some of that book. Guessing you're from the trading fraternity. Long-term GME? I think it looks good. It looks good. I mean, another earnings or two that positive EPS, definitely solid, but even what they did with the last couple earnings, Brian Cohen said they were going to look for more short-term profitability, and they had enough flexibility and leeway to literally just flip their earnings from negative EPS to positive in like 2 quarters. So they always had the flexibility there. They were just reinvesting into the company, and so they didn't care about negative EPS because interest rates were low and money was cheap and easy to get. And so they flipped that once interest rates came high, and now they're free cash flow positive and positive EPS. So yeah, it's solid. It's solid at these numbers. Yeah, I don't know what they are PE compared to others in their field. They kind of on their own a little bit. Kind of compare them to like Best Buy maybe, but not really. At the chart, I mean, of course, down here at this gap fill, I'd say is definitely a buy. But if you're holding long term, 5-10 year outlook, all of this is probably pretty good. We both short at 79. Well, let me show you here. Let me just show you this little. Let me just go through the math with you guys. I don't even want to do it on stream because it's embarrassing, but I'll just show you anyways. So what I've been doing is I've been trading these April options. I've been trading these April options, so I would have gotten April's. Ivy's insane. That's definitely a deterrent. Can I open this chart up? There's a way to open that. Let's see, chart. Okay. So this is the $50 put. This is the chart for that put, the price of that put, right? So if you went long here and sold here, you would have made money, right? So this was their share offering. This was the day, 3:30. Now it's a share offering. This is where I closed my shares. Closed everything. Closed everything. It's like this bearish. Broke close. So if I had bought puts, right, we'll say I waited, got them at 8 cents. 8 cents on the option is actually $8. This times 100 because it's worth 100 shares. Every contract's worth 100 shares. So if the contract's for 8 cents, it's 8 cents a share you're paying the premium on. So $8 for one contract. So say, I mean, $100, that's not much at all. But say I only put $100 in. Like, oh, it's $100 in contracts, whatever. We'll just YOLO, not even a YOLO, just $100. By 8, so it would have been 12 contracts. Buy's coming down. Let's just say 13 contracts because $100 is most options I have. I don't spend less than 200 or yeah. Anyways, so let's just say $13 or 13 contracts. So 13 contracts I got of the 50-cent put on BBBY. What was it, 8 cents? Oh, we said, yeah, 13 contracts. So this thing's come down. The price has come down, so the put value's gone up. Okay. So now today, I'm like, all right, I'm gonna finally close this thing. And this probably isn't even it's probably gonna keep going up. How many contracts do we have? 8. So 8 contracts. Now I can sell them for $24, $192. Wait, is that right? 8 contracts, 24. No. Yes, okay, that's right. Okay, so it's not as good of a play. Wait, what? Hold on. Yes, wait. I'm so confused now. What did I do wrong? No, 13 contracts, that's what it was. There we go, 13 contracts. So $312. So yeah, it's like, oh, it's not a lot of money. But that was only on basically $100. So with a 3x. Not as crazy as I was looking at before. Maybe I did the math wrong before. Here's an easier way to look at it. Say from here to here, 200% move. A 2x. Anyways, yeah. Buy's moving down. Math skills. GME back to VWAP. What's up, Maya? How is that? That actually still doesn't add up to me. Go short 7 cents where it'd be. I mean, shorting the shares, you'd be up as much as it's down, right? So 60% up, 50% up on, well, 60 or so on just the equity on the short. Yeah, 13 contracts. Gets smaller every time you math it up. It's not triple though. That's what's weird. You're in Deutschmark, Germany? Talked about BBY last summer? Last summer? Oh, live discussion on Twitter? Oh yeah. Nice, man. That's crazy, that was a whole summer ago. I don't know if the Restream bot... Oh yeah, does that move over? You guys are able to see the Twitch chat, right? Looks like it. That's pretty cool. Statistics witchcraft, I agree. Full porting at 1 cent. I don't think it's gonna get to 1 cent. If it will, you won't be able to trade it. VIX has been coming down. The market going up. Obs. Kidding. But as you notice, it's getting to kind of a double bottom here on the weekly chart. So it's due for a rally. So a little false breakout. Looks like on spotted upside there. Talc causes cancer. Maybe. Long weekend sell-off. Got about 45 minutes.
At taking Fed funds lower by year end, and likely And tomorrow's number will be really, really important. But keep in mind, I think 8 or 9 months in a row now, we have seen the actual number outperform the consensus. So the consensus continually thinks that jobs are going to come in weaker, and then we get surprised to the upside. That's happened, 8 or 9 months in a row. So it's possible tomorrow that will happen
So
again.
To clarify really quick, what I first looked at was these BY contracts at 4 cents. When I just did the math with you guys, it was at 8 cents. So it had already doubled, which is fair because I wouldn't have gotten into them earlier than that. We've gotten in at probably 8 cents. So.
And that would argue, or at least justify, the Fed to keep going. And we heard
almost
this week
3x,
from Mester.
2.5 times.
I'm sure you saw that, and also Bullard. It seems like we're likely to get at least another hike or two. So for the bond market, that's the unfortunate thing, because the bond market has other things in mind.
Totally get where you're coming from with the trend of our employment beats is kind of being our baseline, right? Kind of a Newtonian approach, right? The object's in motion until we get evidence that it's changing. It continues that way. The data this week offers some pushback to some of that momentum. What do you think of the 3 sets of numbers we got? JOLTS, ADP, and then also our jobless claims. Where is that coming from? And do they potentially offer a little bit of a different trend?
Well, we like to watch initial claims. It's really important for us in real time. You got pretty good quality data coming out every week. So that trend appears to be headed up. I don't want to make too much of this week's data. We had some seasonal adjustment issues, so we'll have to watch it week by week. But it does look like all the stories about layoffs, especially we've been hearing a lot about in California, are starting to seep in to the initial claims data. So that might start to show up in payroll data in a few months. Oliver, I'm just saying that for this particular month, for the month of
the dip that keeps giving is
March,
coming.
I don't know that it's going to really tell us anything for tomorrow, but that's an important trend to keep an eye on. Usually, initial claims for unemployment are creeping up in advance of a recession, which we do expect to happen at some point in the next 6 to 12 months.
Okay. The recession,
I don't know what
Jeff,
these guys
what
expect
do you
for a recession,
think,
like a
the data
big banner in the
could look
sky
like
saying
right
we're in a
now?
recession now.
What kind of characteristics? I mean, is it stagflation? I was looking at a chart somebody sent me the other day from, it was Ben Emmons sent it to me, from 1974. Yields went up, inflation went up, unemployment went up. I mean, people talk about how what wild times we live in today. Holy cow, that must have been awful. I mean, is that the type of scenario?
I have the reins to the horses, and I
don't think this is the 1970s. I think we know the source of the inflation, Oliver. It was the helicopter money drop that the Fed and the Treasury did in 2020 that sent bank deposits up by about $5 trillion in a very short period of time, and then that seeped through. We're still seeing the after effects of that. So eventually, though, inflation will come down. But to answer your question directly, yeah, we'll have a recession, and what typically happens is inflation doesn't come down immediately. It comes down with a lag. So in that interim period, many people might call that a stagflation. I think for us,
not necessarily
inflation
at all,
will come down with a lag. It's just going to take
they
a bit
make
more
good,
time
they make
for
it better than really
that to play out.
anything
So maybe
else
that's a 2024 story. In 2023, inflation is still a bit sticky.
Okay.
But the depth of the recession, that's hard to say too.
Experience.
I mean, I just mentioned $5 trillion surge in the money supply. So I'm sort of like a unreformed monetarist here. I think you had a big boom. It's possible you have a pretty big bust. I know the consensus is like, we'll have a recession, but it'll be moderate. I think that's more hope than any sort of basis in reality. It could be a bit bumpier, Oliver. So
Jeff, I'm
be
curious.
forewarned.
Yeah, totally. No message received. I'm curious how, in your analysis, this is, I know, a complex question. Fed presidents think about as well. So I have to ask you to try and keep it to like 60 seconds. But I really want to get your thoughts. Is how do you, as an economist, assess the stock market's role in this? Because we've had this nice run for 6 months, but if the trend holds, and we got what we got last year, basically after a lot of that helicopter money went into the stock market. How does that affect the economy, and what signal does it give?
Well, I think the recent run in stocks is due primarily to the rally in rates. So rates have rallied, quite substantially in the front end. Rates have come down, as you know. The 10-year is a lot lower, 50 basis points or so in the last couple of weeks. So I think that has helped stocks, because what was the big thing weighing on stocks in the last year, Oliver? Rates had gone up. So that's just, for me, is a temporary salve or a temporary boost. I think what the stock market has yet to wrestle with is a recession. When the Fed is cutting, when the recession is underway, that is usually bad for stocks. It's not unusual for there to be a lag between when we're talking about these things in terms of the bond market and the stock market pays attention to it. I remember very well the S&P rallying through October of 2007. So by that stage here, we had been talking about for the better part of a year, maybe longer, about the recession that was underway in housing and the spillover effects from that. So
very important point.
I think stocks still have some more pain to be felt. It might just be that it takes till later in the year for the stock market to really wake up.
Understood. All right. Speaking of wake up, I'll let you get some sleep early morning for you, Jeff. 5:30. Appreciate it, sir. Good to catch up. Jeff Cleveland, Principal and Chief Economist of Payne & Regal. All right, coming up, let's get another take here, and let's get stock specific. Our next guest has some companies that might just be able to thread the needle. We'll be right back.
Good bounce on Corsair. ADP. Dr. P. Always interesting to me to see stocks rally after a dividend. Hey Jason, how's it going down there? Good morning. No, is it that early? Are you up in the middle of the night? I come down some more. AMC come down to VWAP. GME broke through VWAP. Curious what happens at this trend line support. Buy the double doji. Might see a bounce here on this support line. Seeming like it wants to stay up in this range. Got about 30 minutes to close.
The show. Thanks for
Pretty
being here this
bullish close
afternoon.
if that's the case.
Great to be with you.
Appreciate that. Let me get your quick take on what we just heard from our previous guest about the potential for recession
Jason.
and
Thanks, man.
potentially another pretty big shoe to drop for the stock market.
I think it's an interesting discussion. I will say our indicators that we look at are not anywhere as elevated as they were last year when we went through that pretty severe bear market. And we're watching very closely the credit default swaps of a lot of these banks. They are not blowing out. Things like volatility, the VIX is 18.5. So credit spreads are not blowing out either. So, we'll see. I think there's more shoes to drop with the banking crisis. We've got office real estate as a problem lurking out there. But, right now we're encouraged with the resilience of the market and the way some of the risk metrics are acting.
Okay. A couple of the companies that are on your list I want to highlight, kind of starting with a few that have done very well, maybe take a little bit more of a positive tone to that point. On Semi, as we're trying to figure out the fate of the economy, semiconductors have the added complication of being stuck between U.S. and China. On Semi has managed, it seems, to kind of thread that needle and have a really great, not just year to date, but a full year now. Why is this stock on its own basis outperforming some of the other big giants that we're talking about that are still off their highs?
Yeah, on Semi, I think it's an exciting growth play, a more reasonable growth play on electric vehicles. Their chips manage power, and specifically the transfer of alternating current to direct current. Direct current is the battery, and then alternating current is the motors. And they're using silicon carbide, which handles heat better and gives you 10% more range and 10% faster charging ability. So I think, is very well positioned.
What about these DC motors?
What we like is a cheaper, more reasonable play on some of these secular growth themes.
It seems like between FCX, the copper, which as these charging stations are built out, as the batteries are built, we've heard a lot of reports about how copper is going to be in a huge amount of demand. And ETN, another one that connected to the electrical grid. It seems like you have faith in the long-term viability of the energy transition.
Yeah, I think Eden is another one like that is a play on the build-out of the electrical grid. I mean, we just don't have the capacity for half the neighborhood to be able to charge their car, and Eden makes the transformers and the systems that make that happen. So, Eden is reasonably valued. It's a dividend aristocrat. It grew its dividend right through the financial crisis. So that's the kind of profile that I think can do well with the backdrop we've got.
Okay, and more of kind of an industrial play. How will we know if let's say that recessionary view does come true? What will you be looking at? What kind of data, what signs will tell us if the energy transition and build out is able to occur even during a period of slowness? I know last year, obviously, the government came out and spent a lot of money and a lot of initiatives to kind of buttress it, but can that sustain if we really do have a major downturn?
Well, I think you're right if it's a major downturn, but remember the labor markets were at 3.6% unemployment, and the Fed's is trying to get it to 4.6%. So the resilience of the labor market, I think, argues for a more moderate recession. And like your previous guest said, we pumped in $5 trillion of spending, a lot for infrastructure. So there's some strong tailwinds behind the EV secular trend.
What about what we're seeing with Tesla? Not to go off the rails here for a sec, and I don't know if Tesla's a stock you like, but as the leader in EVs, seems like they are really needing to cut prices right now to stoke demand. Does that have any leading indication at all for the sector?
We like Tesla. I mean, we had a problem with the valuation. We've got a value discipline where we tend to be GARP investors, growth at a reasonable price. So we hadn't owned Tesla for part of that later run. But when it pulled back to just over 100, it started looking pretty reasonable relative to its growth. And remember, Ford has lost $3 billion on electric vehicles, and Tesla brings $13 billion to the bottom line. And part of that is non-union, part of that is not being saddled with the legacy automotive of GM and Ford. So, I think Tesla has the ability and the margins to be able to cut prices and remain profitable.
Double.
Okay. Good stuff, Tom. Looking forward to continuing the convo. Appreciate the analysis and explanation.
Thank you, Ace.
Thank you. Good to be with you.
Absolutely. Tom Samuelson, Chief Investment Officer at Vineyard Global Advisors, with a few quote-unquote backdoor electric vehicle plays with OnSemi and FCX for the build-out of the grid. All right, let's talk some options. Tom's got a few trades when we come back. We're looking
This
at
is
Meta
Ace tomorrow.
as
Heading
the
to
job
Austin.
cuts and year of
Nonsense,
efficiency
booby
continues
pants.
to make
I'm on my
investors
way.
happy.
Thank you, Ace. Appreciate it, man. Just silent dono droppers. Dope. Have a good one, Ace. Thanks, buddy. Have fun in Austin, Lakeway. Don't get deported. Nice play on MSG, still good. Yeah, this one just woke up out of nowhere. It's funny I was even looking at it so early. 'Cause it didn't even, like, it just looked all choppy and penny, but it was holding nice 7%. And then just kind of woke up with volume. Got some day traders in it. Around this $6 level. Oh, and even this part looked nice. Kind of flattening bottom. Or no. Oh yeah, here on the daily you can see it. I was saying this looks like how BBY, this is what we wanted to happen on BBY after it traded flat, but it went the other way. CGen. Yeah, just playing the support and resistance, you might get something. 5 did end up bouncing there. Eyes ripping up now. About 30 minutes. Setting up a bull flag there on the hourly. It's engulfing on the daily. Why don't I close my short? I don't know. And now have a great Easter weekend, everyone. You too, Ace. I missed your message. Happy Easter, buddy. UNG? I thought you meant to say UNG. I look at it sometimes. Not ready for 5 dailies? Are you trying to say UNG? Keep saying UHG. You are trying to say UHG. Oh yeah, you mentioned this one the other day when it was going crazy. Yeah, we looked at it the other day when it was rallying. Made the old cat ears formation.
.3% above the current share price, with over about 250,000 calls traded on the session. As I mentioned,
SPX options, what are you going to do?
Getting to overbought levels.
This
is eerily reminding me, Oliver, of the rally that we saw in tech going into the .com bubble, where everybody's pushing into everything.
What, now?
Yeah, well, I mean, it's a lot
2
different.
years ago, Tom.
No.
That was the COVID bubble.
Yeah, the COVID bubble, too. But, you know, it's getting a little bit frothy here. It seems like everybody's piling on board. You know, they've got the outlier that if TikTok gets banned, Meta platforms will probably benefit from that as ad dollars come back into their platforms. That'll be key, and how they monetize Reels moving forward will be key. And then take a look at what Zuckerberg says going forward. Does he continue with his theme of cost efficiencies throughout this year and kind of push back against the metaverse, which has been, the one that
rejecting that 409, and now it's setting up a bit of a head and shoulders here.
A couple of earnings ago on that note. So he's kind of pushed back. He mentions AI a little bit, the generative AI.
Oh, yeah, you got to. You want to keep a job these days, you got to talk AI.
Yes. So, as Kevin Hinks always says, he's acting like a real CEO over the last couple quarters.
Oh, I thought you were going to say that Mark Zuckerberg bought Boeing shares.
Oh, no. Kevin does like his Boeing. Yeah.
I thought you were going to say Mark Zuckerberg's Facebook was a beach ball held underwater.
No.
Okay.
He's acting like a real CEO over the last couple quarters.
Got it. Okay. Hey, I mean, I agree with that description. All right. Shares up 2.5%. People buying calls.
Yeah.
What else is there to say?
That's it on Meta.
All right, we're getting bulled up again today in the whole comm services space. Alphabet having a great day too. How about Warner Bros? Let's talk some streaming. WBD.
Yeah.
I think also kind of in the category of streamers, it's kind of undersung,
underappreciated in that space.
Though I do feel like we get a little bit more from Paramount. I feel like the stock is, I don't know, they both have really gotten creamed now for like 2.5 years.
Yeah,
and Netflix is making this big comeback, and they're kind of ho-hum.
Yeah, and think about this. The stock was trading about $8.80 at the end of December. You can see that dip there. That was 14-year lows. Around $8.82. The stock's up about 59% so far this year, but that you start thinking about percentages, right, as opposed to dollar amounts. It's only up $7 from those 14-year lows. But they're nearing a deal for Harry Potter television show based on the book series. Each book will have a season. That's one of the bonuses. Free cash flow and deleveraging have improved for this company. Its direct-to-consumer and HBO offerings currently undervalued versus peers, and potential profit ramp in this. Now, they got a lot of content under there, and I think it's 1 year since they merged on this, Warner Brothers and Discovery, exactly 1 year ago. So, and some unusual option activity in there. People buying calls to the upside, thinking that this breakout that we've seen in 2023 are going to continue.
Hey, you nail it with the Potter show.
Yeah.
And you're, the video game they released was huge.
Yeah.
So they do a TV show now, HBO. That'd be pretty sweet.
Yeah. Each book a different season. So what? You got 6, 7 books?
What?
Yeah,
that's the way they would do it?
Yeah, that's the way they're talking about doing it.
So they'll just redo everything?
Yeah.
Count me in.
Yeah, I'm a big Harry Potter fan.
I mean, yeah, but the same plot over again?
Yeah, maybe. Okay. Different characters, I hope.
Right. All right. Okay.
All right, so...
Are they doing auditions for Potter right now?
I don't know. I don't think I'd qualify, but...
No, you're definitely Snape for sure.
For sure.
Malfoy all the way.
Oh, yeah, for sure. Unusual option activity in here. April monthly 15 strike calls. Over 15,000 of those were bought up earlier today. Average debit of only 45 cents, so that break even of 15.45 over the next basically 2 weeks is only about 2% above the current share price in there. Call volume is about 4 times normal daily average volume that we've seen over the last 5 trading sessions. So yeah, people pumping into this stock and thinking this rally that we've seen so far in 2023 is going to keep extending here over the next couple of weeks.
Okay. All right. Let's take a look at your last one here. As Wells Fargo got a pretty solid analyst note saying to buy it up basically because now the federal scrutiny is going to shift to smaller banks. That's kind of the way I interpreted that note.
And the fact that Wells Fargo has taken advantage of some of these failures in the regional banking sector, and not even failures, Oliver. It's just funds coming into a lot of these banks just because people are afraid of leaving their money or investments in some of these smaller regional banks. And Wells Fargo has taken advantage of that. You mentioned the Raymond James analyst note today. They upgraded Wells Fargo to a strong buy. They already had an outperform rating on the stock. They lowered the price target to 47 from 52, but a bunch of positive catalysts moving forward. They've got earnings next Friday, kickoff of earnings season next week, Oliver, with the banks, most of the major banks, Citigroup, JP Morgan, Wells Fargo on Friday. And traders were setting up maybe for some upside in here going into this report because traders were buying The April monthly 40 strike calls, about 5,000 of those for an average debit of only 42 cents. So the break even for this trader at $40.42 over the next 15 days, about 6.5% above the current share price. So yeah, it'll be interesting to see what the banks say on these earnings calls and the conference calls following the earnings, what type of outlook that they have for the economy, not only their company specifically, but just the outlook for the U.S. economy. Jamie Dimon came out in another interview today, and he said the risks of recession continue to increase. He said that to CNN today. So, yeah, these bank earnings, which typically are pretty ho-hum as far as moves.
They're going to be the highlight.
They might be the highlight and set the tone for the entire earnings season.
Okay. That would be really important to see because they're carving out very clear on the chart, trying to carve out lows. A lot of these banks have got slammed. So if we break below there, then could be opening up a whole new can of worms.
Yeah.
All right, thanks, Tom. Interesting trades. Okay, for the most part, pretty optimistic and bullish trades. We're going to get an update from our food reporter, Jenny Horn, in a moment about Starbucks. We're going to do some trading with Bob Iacchino and crude oil. And then we've got our Schwab panel.
Now taking to social media regarding Starbucks' new line of olive oil infused beverages. And apparently for some, the picture is not so pretty. Now on March 16th, a post titled "Olive Oil Drinks" was added to a subreddit thread by a Reddit user that claims to be a barista at Starbucks' locations. In it, they share experiences that their coworkers had allegedly trying this new roster of oleata drinks. And these drinks, like I said, infused with this type of olive oil, which I frankly think does not sound very appetizing to begin with, but whatever you're interested in, they were unveiled February 21st in select markets. If you're in the Chicagoland area, they're actually not available to us here, so we are safe from the side effects, it appears. But Starbucks has not responded to a comment regarding the subreddit thread that has really taken off. If you actually search the oleata line of beverages, you can see all of the various opinions regarding it. Very interesting, but the line does include lattes, shaken espresso, cold foam beverages, beverages, martinis, and more. So it's several types of drinks. One customer has described the Oleato beverage as a legit laxative. So do with that what you will. It doesn't sound very pleasant. I would be avoiding olive oil in drinks altogether because it's, I would say, with a stimulant and then with olive oil, I mean, there's too much going on. And Oliver, this only rests my case why I avoid coffee.
Oh, yeah, because you avoid stimulants in your drinks. You'd rather just drink right out of the chemical factory than the olive oil.
At least for some controlled digestion.
Okay, fair enough, fair enough. But is it subreddit people being goofy, or is it like the stock's not really doing much?
No, the stock doesn't care at all because this is just one line of a very successful beverage change. Yeah.
Hey, we did $28 at Taco Bell. How bad could this be?
Well, I looked. I was trying to see actually if we could try some of these drinks. We can't get them around us, so I'll do some research. All right, we'll try it out. But I don't think it sounds like a very pleasant office experience to do all together.
We got to hire an intern. All right, thanks, Jenny Horn. Appreciate it. Host of Next Gen Investing with the update. Starbucks, a little change, shrugging it off. Okay, let's get serious. Bob Iacino's going to trade some crude oil. He's hopped up on some Oleato. No, but they might have it where you are. Oh, there it is. Well, a good Italian man, you've got an espresso on hand, of course.
Of course I do. Next time you see Jenny in the halls of the TD Ameritrade Network Ivory Tower, ask her to explain controlled digestion. That's like Jerome Powell's adjusted average. I don't really understand
Nice. They're good on you to bring it back to the macro for us, Bob. Hey, we're kind of like in this standstill before tomorrow's big number. You know, not very open market, like 45 minutes. I want to get your thoughts on crude oil as kind of a sleeper story this week. It was the highlight when we came in on Monday. Kind of drifted into the background. Should that be the case, or should we be keeping an eye on this?
We should be keeping an eye on it. We had 2 weeks in a row now of refinery utilization above 90. That means two things. Number one, we have refineries reopening after turnaround, getting ready for that summer blend. And number two, the demand is going to be stark, at least in the beginning, unless the actual demand on the ground falls. If you start to see gasoline prices rise up again, and I had a lot of people complaining to me on Twitter and elsewhere that oil companies, again, were gouging because prices had gone down, but gas prices had not. Prices went down so fast and then so quickly back up that gasoline stations are still working off old inventory at higher prices. And now we're back at the top end of that range with just a hair of a breakout getting above 81. You realize that 80, I think it was 81.81, it might have been 81.61, but that high that we got this week was the highest we've seen crude since the end of January. Okay, and that's when people were still worried about inflation. The Fed was in the meat of its tightening. And now we talk about commodity prices have fallen, goods inflation has gone away, and we're seeing the sort of effect of services inflation, which we've talked about before, Oliver. Services inflation is not that wages of the people who got the raises come down, it's the layoffs begin, and we're seeing that. So what happens if crude oil, which is the driver of goods inflation, starts to rise? It's an extremely important topic in the next couple of weeks.
Okay, what's the framework, the levels that you're working off for crude? What do you think's possible here?
Well, I think in the short term, you're definitely looking at $82, which sounds stupid considering we're at 80 and we've already been in the high 81s. But you want to see a breakout of that if you're long, then you want to see it get retested.
GME
and then
also.
We're talking about 95. I went on record as saying 95 before 65, and then 65 cratered. And so I was wrong on that. 95 still my target because to me, the downside was a false breakout. A lot of people talking about how the administration
I don't see the same movie anywhere. Just consolidating near the highs here, chopping around.
Overall ability to
now you got 10 minutes of
refill the
Fugazi.
SPR. I don't know if that's necessarily the case or not.
Thanks,
but if
Jonathan.
they
You too,
have to
man.
come back in and buy because they think crude oil is going higher. OPEC tends to lead toward the extreme. Okay, they tend to lead toward a situation where demand might exceed supply and we need to pump more, or demand might fall off a cliff and we need to cut production. They've cut production in anticipation of demand falling. And if they're wrong, you're looking at $100 a barrel.
All right, nice. There it is. Good window for us to keep in mind on our charts. Appreciate it, Bob Iacino. Or is it Bob Cappuccino? Close. Okay, I heard him. He got a little laugh there.
Oh my gosh.
All right. Appreciate it, Bob. Chief Strategist at Path Trading Partners.
Sure, he's never heard that
We're having
one.
a little fun here on our Synthetic Friday. Let's get serious with the Schwab panel coming up next. Liz Ann Saunders does the round trip from this morning. We'll extend our discussion with Colin Martin, Director of Fixed Income Strategist. So, you know, we're talking some bonds and we're talking jobs.
Might have been a shakeout. Might have been a little bear trap. It's all right. I stream also the corny jokes. It's hard not to do them. Hard not to. Just end up saying stupid stuff you never wanted to say. A little head and shoulders here on the 5 minute. It'd be nice if that played out, but only 9 minutes left. Felt so proud. Okay, wait, I gotta figure out. I think I have stuff expiring today even. Heck. There, not there. MSG holding that high. Look at that. No, nothing expiring this week. Not until OPEX. $0 in the run. On what, this earnings gap up? It was highly unexpected. We haven't seen a gap up from earnings. I don't know. Since I've been trading it, it's been years. So, and not even to say that you could have made a lot of money because for whatever reason, the options didn't move that much. It just was a one-day thing, you know? It opened up and it just sold off since it opened. Just a slow grind down of IV crush. So it was like, had to sell ready to open and that was it. It didn't get any sustained rally, so they're just, yeah, options sucked. I mean, they didn't suck, but they really didn't get anything juiced into them. Here's the last earnings gap we had, and it was to the downside. That was 2 years ago. Yeah, I don't even know the last time GME's had an earnings gap. I mean, you can look on the chart even. Yeah, it's been like, I think 2019. But nothing like that. So, I made money on it because I was expecting a rally. I just wasn't expecting an after hours. Just from the chart. I made a lot less than I would have. I basically hedged and missed out on about, I don't know, 7-8 grand. Because I forgot to close my covered calls coming into it and wasn't really thinking it would matter. Which I know better, but yeah, I forgot. I was streaming that day, of course, and just got distracted. I think the stream stopped and it like restarted, or I can't remember what happened, but I just got distracted and forgot to close them out before close. But again, it wasn't something I was necessarily thinking about because GME never does a 50% gap up after earnings. Yeah, IB sucks on GME right now for selling premium. Buying it's good, but we never see moves that cause it to go up. So, if there is a crazy big move, those options are going to get sick. Like, huge IV mover. There's an engulfing on the 5 minute. Got 5 minutes to go. Here we go. Let's see a close under 407. Let's do it. Come on. Nice big flush, flushy flush.
Needs to. Now, right now, all of the comments we hear from Fed officials are that they're still moving forward. They've sort of tamed their outlook a little bit, tempered it a little bit, and we're really only expecting one more hike. But they've told us they plan on holding for a little while.
Yeah,
now, things can change, of course.
Still make money on it.
To totally take them at their word.
Be more aggressive with your
but
strikes.
they're telling us that the fight against inflation isn't over yet, and they don't seem too spooked by the recent.
Did you close before the earnings, though?
However, there is a negative downside to Fed tightening, and we're starting to see that in the broader areas of the market. We think we'll continue to see it, spill over into the labor market, which has remained relatively strong. Nice. We think we'll see some cracks form there, but a lot of the data this week is supporting that thesis. When you see both the ISM manufacturing and this ISM services
nice. Yeah, I bet you did.
To move
IV was what, like 120% or so?
Concern for us.
At open that day.
Reminder there, as we've been so focused on the jobs data, almost forgot with the big services miss in particular, new orders kind of plunging. Lizanne, is there any obvious reason why the data chose to take the turn this week? I mean, I know we got the revision as well, so it kind of has been building here, but it just also feels like this is somewhat sudden. I mean, is this like the tech layoffs that have been building up?
To think about it, though.
Spread into companies like Walmart? I mean,
where's
this coming
Tuesday,
from?
the 18th?
Yeah, some of it is what you said, but it's also the case that every once in a while you get these longer-term revisions, and we know that a lot of the labor market data has had seasonal adjustments that have been questioned as to whether they're actually picking up the right seasonal information. And the adjustment that we got today with claims wasn't just about the prior week, but really paints a very different picture of last year heading into this year than what we originally thought was the case, where there was more volatility, kind of choppiness in a range in claims. It now looks like claims were actually in a good, somewhat descending pattern until the fall. Then they started to accelerate and really picked up in January. It's just with the adjustment, we now know that with the benefit of hindsight. So these are larger than your typical claims-related adjustments, but it's really just now matching data like claims with what we've all been seeing for several months now in things like
Have you been rolling them down or just riding them?
It actually, what happened with these revisions makes sense. Is, given and being an observer of the background conditions. And so it wasn't really sudden. What was sudden was just finally getting those seasonal adjustments in the revisions.
From yesterday's peak right here,
to connect
all the way down,
from
just
stocks
all the way right back
quick
up to where we were.
To that, Lizanne, we talked this morning about the correlation between yields and stocks. I would encourage folks to go back and watch that interview. Really good charts to put it in perspective. But as we're seeing bonds react this way to the data, are there particular parts of the equity market that then look vulnerable?
So, as you know, Oliver, we've been more focused on factors as opposed to things like making a monolithic call on a sector or two, or even the
you only had one Friday since earnings. It's last Friday.
Clearly, what 31st. Makes sense in this environment is to look at the macro backdrop and see what's dear, what's missing. So
you don't roll before expiration
environment, you want to look
for interest
coverage, cash position, strength of balance sheet.
You literally just
strong
let them
cash
expire,
flow,
worthless, out of the money.
As a company, you've got the short duration cash flows and earnings. You don't need to access the capital markets the credit markets or the banking system. You can fund your operations. We're in a deteriorating earnings revision environment with more negative pre-announcements. You want to look for companies that can buck that have that positive earnings revision, that can maintain pricing power, lower
even
beta
if you're profitable,
stocks make sense in this environment. So that's the way we've been suggesting you navigate through this somewhat tricky environment.
Yeah, I would always.
Glad we got that in there.
I would always just buy to close them. I wouldn't let them expire.
When we're looking at this number,
you don't know what happens after hours.
And then get called away after hours on it. Mind, we're really focused in on wages, but
say a 25
obviously it's important, but I did kind of wonder with all the top line jobs data misses,
today.
Is that going to be
after
as
hours
big
they
of a
announce
focal
something, it
point
goes up to $30. Someone can exercise their contracts.
Concerns, or is that
you get called away.
Really the most important kind of sub point?
Which I'm sure you already know that, but yeah,
I
always buy to close mine.
It's one of the most important. It's tough to pinpoint exactly what's going to be the key.
Only time I have it
things
is
we're
with,
looking at, of course, are one, just the main headline.
Sorry guys, well that's the bell.
How many jobs are added?
The only time I have it is with
average hourly earnings. I think
BBBY,
that's really important because that can really
it.
flow into the inflation outlook. When you add those together, if people are employed and they're seeing their wages grow, they're likely to continue to spend. And that's really, I think, what it comes down to. If you're not worried about losing your job and you know you're employed, you might not change your habits just yet. I mean, when you hear headlines about a recession, maybe you get a bit concerned. But if you continue to get those weekly, bi-weekly, monthly paychecks, whatever the frequency is, you're likely
okay, guys,
to keep
no video
spending
today, as you
that
can
money.
tell. 4
One
o'clock,
thing we are
end of the
looking
week.
at, though, is
Tomorrow we're gonna get data.
average
Futures will be open.
hours worked
Market will
per
be closed.
week. We
Have a
have
good
seen them
Friday.
trend down a little bit, and that's a little thing that might not catch a lot of investors' attention. But not that I would say it replaces layoffs or something like that. But if workers are working less, that is less money in their paycheck. So we're going to be looking at the headline number, average hourly earnings, and also average hours worked per week.
Great stuff. All right, excellent setup. Calling those in. Thank you very much, team. And have a great weekend as well.
You too.
We'll just have to wait for data now. Which way we're going to go.
And stocks, all green.
Is what I'm thinking.
Look at the Dow.
I was bearish yesterday. Less bearish today with this engulfing candle.
NASDAQ with a good comeback.
Kind of knew it was coming because I assumed something like this was happening again.
Pretty solid turnaround.
Not just a straight sell-off from the top.
Meta in particular.
So I think
other companies,
hopefully tomorrow will give us direction. We won't just chop around for another week.
You might have missed, as well as a look here.
I'm holding these short futures into
from
it
a
for some
risk
stupid
management
reason.
perspective. Nick joins us for a panel alongside Renita when I come back.
Okay, I'll just hold it. Anyways, that wrapped me on. GME. Not a whole lot to report. I'll just give you guys a little recap. What happened? Well, GME popped up through that zone, which is very odd. That support has been building for like 2 weeks. Broke through yesterday with a vengeance and melted back up all day, and then found it as resistance, which makes sense. Yep, resisted right at close, and then today gapped down and rallied up through it. Now we're above it, so that support line is losing credibility for me. So I've got some channels here, see what plays out, see if we kind of use this as resistance, and if we make a new low, if we break out to the upside here, we're back in bull flag territory. This is just a false breakout. So I flipped from long to short here though, and feel stupid today, but that's what we got. Bed Bath. This was actually the most mellow day on Bed Bath. Weird, huge volume volatility in the morning that sold off and broke yesterday's low, but after that it's been probably one of the flattest days we've seen. BY did come off reg show yesterday, so I don't know if that's having an effect. The bot is just rounding a little bit, maybe. Kind of see it on extended hours. It's starting to slow down. It's descent. This was an airplane. It's coming in for landing. So look for next week. You know, we just need one day to not set a new low, and yeah, see where we're at then. Today's low is 29.80, so kind of that 30 cents was support and just stayed there all day. Not much going on with that. GFAI, this thing rallied today. We actually caught this one at 7% on this candle. It was on my list from before when it rallied, and this was another reverse split one that we've watched, so hoping for something similar to this with BBBY. But yeah, today we caught it 7%. It was up, and I didn't have any buying power because these futures. Anyways, then it halted and proceeded to go up like 50-some%. That was a cool runner. And MSGM too, same deal. We were watching this one about 7-8%, and then ripped and up 40% now. So big move on that one too. Even got MCOM to wake up. We need trading today, which is kind of good. Okay, EBTL. This chart still looks really nice. I think this thing could wake up soon, hopefully. Wish did come up some today at 5%, so that's better than it was. Yeah, no trading on there. Oh, I did. Okay, so I closed out of my cash grid puts on AMC that I opened yesterday, 2 days ago. Or I opened 3 days ago, right here. Open them up. I got lucky and got out of them today. Basically with a tiny profit, so I feel blessed on that one. And then, oh, I closed out of my BBY calls. So I've been opening up calls on BBY. I didn't open them today. Trying to get a good deal. I've been opening up calls on the lows and then selling them at open the next day, just to give myself exposure for overnight. But yeah, so yesterday I was able to open for 5 cents, and today I closed it for 5 cents. But yeah, I don't have any now. MCOM, kind of the same thing as, oh, look, a little rally into close. This is kind of future BBBY, because they just had a reverse split. Very similar price action even too. This was Hellbiz. Gap down on the reverse split, and now it's just been selling off. Big volume today. This thing might have actually bottomed. Oh, an average down on this would maybe make sense. Might even get some after hours. I like that hammer candle. I like all that volume. I don't like to necessarily dip by, but those are two good indicators. Like the last time. Not really, but where'd all that volume come in? In today? Yeah, I might pick some up of this. I already have some, just a little average down. Let's see. Huge spread after hours. Okay, put in an order out there. Let's see if I get it filled. I think it just dropped down because of my order. Wait a minute, what's going on here? 225. Got it for 228. Fill me. Won't fill me. 228? Is that me? Oh. Alright, we'll see if that gets filled. Oh yeah, AMC had that big rip up today. Kind of weird. Don't know why that happened. AI, nice bounce. Sorry for the bell, guys. Thanks for hanging out. I'm Gilly, Thundercube, Dennis. There, got filled. Word. Okay, put that in Discord. Bungie. Yeah, I would definitely close out if you're selling premium. I would always close out. Buy to close it. You get some crazy after hours news, it just goes crazy one way or the other. It's not worth for that last penny. Not at all. Unless you're rolling it, then you're gonna have an open contract. But if you're not gonna roll it, you're just gonna let it expire. Close it, close it, close it. Always close. Thanks, Christopher. Happy Easter, everyone. Time and risk off is worth more than $5. Yes, that's right. I don't necessarily wait. Sometimes I'll wait till more than $5. Like I'll put an order for 1 cent or 2 cents because 1 cent doesn't always fill. Sometimes it just won't if it's the day of expiration. But yeah, reducing your risk for sure. Okay, so now we've got what, 500 more shares of MCOM. Still a very small position, but it is kind of a dip buy, which I don't like. So thanks, Krepkin. Happy Easter. Have a good weekend, guys. We'll see you maybe on Twitter Spaces this weekend. Follow me on Twitter at HappyMoneyYT. Sub up, like up, comment down. Happy Money sticks around. There's our Twitter at MoneyYT. Or our Discord server. Link for that is pinned. Funny chocolate piece. See you, Christopher. See you, Dennis. There, guys. Thanks for hanging out.